Starting webinar now.
Good morning, everyone. We're going to give everybody another minute to try to get in. Okay, we're going to go ahead and get started. Good morning, everyone, and welcome to our 4th annual CLE on developments in consumer financial services litigation and enforcement. My name is Ryan D. Clementi, and I'm the co-chair of Saul Ewing, Arnstein, and Lair's Consumer Financial Services Litigation Practice, and I'm resident in our Princeton, New Jersey office. We have a terrific slate of presenters here today from our firm as well as other firms across the country. We'll also be joined by a number of in-house counsel from a variety of financial services companies and an attorney from the Department of Justice who has agreed to speak to us about enforcement activity and fair lending issues. We're going to examine today some developments under the Fair Lending Act, the Telephone Consumer Protection Act, the Fair Credit Reporting Act, and we're also going to discuss the management of high volume litigation issues with some industry leaders. But before we get started, I have a few housekeeping items I need to address. Questions can be submitted through the Q&A tool at the bottom of your screen. We will do our best to answer the questions submitted, but should we run out of time, particularly out of time on any panel, we will follow up individually with an email after the program. Today's program has also been approved for distance learning CLE credit in Delaware, Florida, Illinois, New Jersey, New York, Pennsylvania, with applications pending in Minnesota and Virginia. If you're outside these jurisdictions, you can contact Lauren Kalk, whose information will be provided after the completion of the program. As a CLE provider, we have to verify your attendance, and therefore at random points during the webinar, we will display and verbally announce 2 numeric reporting codes that you must record and report back to us using the CLE survey that you will receive in the reminder email at the conclusion of the program. We will in turn then send you a certificate of attendance once you've completed the survey response. Please be sure to send back the responses with your numeric codes within 5 days of the program. Following the webinar, you will also receive a follow-up email that includes links to the webinar recording and a supplemental presentation materials. Now for the legal disclaimer. The provision and receipt of information in this program is not legal advice and does not create a lawyer-client relationship, although we'd be happy to form one with you, and should not be acted on without first seeking professional counsel who have been informed of the specific facts of your matter or your issue. And with that, I'm excited to introduce our first panel, which is our Fair Lending Update with Trip Riley and John Ropeke. Trip is my co-chair of the Consumer Financial Services Litigation Practice and is our resident fair lending and RESPA expert. Trip has represented a variety of financial services companies over the past 25 years and not only defends his clients in individual and class litigation, but also provides compliance advice and due diligence. John Ropeke is another member of our Consumer Financial Services Litigation Group and is resident in our Chicago office. John has practiced for more than 30 years, focusing on consumer finance, class action defense, and other commercial litigation. He is recognized as an industry leader on fair lending issues and regularly speaks and writes on the topic. So with that, I'll turn it over to Trip and John for our first panel.
Thank you, Ryan. I think this is going to be a great panel and a great overall presentation. We can move to the next slide. I'm going to serve as the moderator here primarily, poke John a little bit, get him to answer a few questions, but otherwise John is going to lead the discussion on this. So without further ado, let me turn it over to John. John, why don't you take it away?
Okay, thanks, Trip. I'm going to need poking since it's an hour earlier than you are out on the East Coast. So where we start is redlining. That's really become a hot issue again. And as I say in the headline here, it's one thing that didn't go away entirely under the previous administration. Over the years, we've seen a lot of cycles in fair lending. Some administrations promote it. Other people, well, bury it. And we've seen that over the last 20, 25 years in different administrations. So what I'll start with, and I'm going to read this one because, you know, I'm half awake. I suspect others on the program watching it might also be. What is redlining? It's when lenders deny or discourage applications or avoid providing loans and other credit services in neighborhoods based on the race, color, or national origin of the residents of these neighborhoods. This comes from something that is brand new, the Trustmark complaint that was filed in October of this year. This is a classic definition, and this is one that we will see a little bit more of to flesh out what those terms mean. This is something that was a first because both the Justice Department and the CFPB were the plaintiffs in the case that was filed, and of course, the consent decree that went along with it. Let's go to the next slide. Now, what has happened recently? You know, if you go back a number of years, there was a lot of redlining going on that was caught by the federal government in one place or another. And it kind of came to a head at the end of the Obama administration. There were some very significant ones, but more recently, it's still going on and at a reduced level. There was a HUD conciliation agreement with LoanDepot.com 3 years ago. This was pretty minor because we're only dealing with a couple of homeowners on tribal land. So we're talking about $340,000 in relief to the homeowners, as opposed to, for example, the Hudson City case in New Jersey a couple of years before that, where we're looking at 25 million. Big difference. We did have one case against First Merchants Bank in Indianapolis. This is what we call a classic horseshoe-shaped CRA self-assessment area. And what does that mean? This is something that's popped up a number of times in these cases where the allegation, at least, is that the bank somewhat deliberately or not basically refused or failed to serve minority areas, and these minority areas were encircled by the branches that they did have that served majority white areas. This has happened in Indianapolis, resulted in relief to consumers, but no fines. This has happened earlier in other places that I won't go into. John. Something else happened just last year that it certainly got us interested. The Townstone Financial case here in Chicago, a non-bank retail mortgage lender. Now this is important. This is the first non-bank that got hit with one of these things, marketed on a radio program and got 90% of the loan applications through it. And they said some disparaging things that were, at least according to the CFPB, designed to discourage Black applicants and to give loans in majority Black areas in Chicago. This was kind of interesting in particular because if you go to the next slide, man bites dog. How often do we see somebody move to dismiss an enforcement action? Well, we saw one here. Townstone filed a motion to dismiss the CFPB's case as opposed to the typical situation where there is a consent decree that goes along with it. They challenged things that haven't been challenged before. Regulation B includes a prohibition on discouragement of applications. They said, no. The ECOA does not authorize that. That's wrong. That should be stricken. They also said that the prohibition it violates their First Amendment free speech rights. And the Fifth Amendment, let us not forget, because it does not give fair notice of the violation. The motion to dismiss, which was filed last fall, has been fully briefed since April of this year. And last I checked, Judge Valderrama had not yet issued a decision. The tradition in Chicago in federal court is never to give a decision date. You will rule by mail or now by electronic means when you get to it. And he hasn't gotten to it yet, so we're waiting to see what he makes of all of this. Needless to say, the CFPB vigorously objected to the points that Townstone raised. So this will be interesting. We'll see what happens because we have a ways to go on this particular little drama. Well,
hey,
what
John,
else?
John,
Chip?
let me just ask you a couple questions on the last two slides.
Yes.
In particular, the self-assessment. In your experience, you know, when you're doing a self-assessment, and I guess you're going to then disclose whether you're in compliance. Have you noticed anything in the recent past where that sort of self-assessment has resulted in the same type of consent order, but where the fines or penalties seem to be slightly less, given that it's a self-reporting?
Not really. Keep in mind that the CRA self-assessment area is simply the bank's choice about this is the area that we serve. That's their prerogative to make that determination as to this is our area. As we'll see in a later slide with the bank in Memphis, they picked their area, 3 counties, and every case that's come up deals with an assessment area like that. What do they do within that is the problem. And of course, the data is being reported by virtue of the Home Mortgage Disclosure Act. They really don't have a choice about that. In terms of what you make of it, the government is the one who will look at it and say, we see something very disturbing in what they are doing within that self-assessment area. And again, we'll see that in the later slide. There's a very graphic illustration of that in the case that was filed in October.
And on the issue of discouragement, do we have any precedent or that sort of clearly lays out what the standard for determining discouragement is?
There's almost no reported case law on that subject. This case, Townstone may make some law on that. What does it actually mean? And you know, it hasn't been pushed. You know, what we've seen in the past is typically a fairly clear pattern that you have this area that you're covering and you have this part that is majority minority, and you're not serving that. And usually the pattern is pretty clear because of where are the loan applications coming from, where are the loans being made, as opposed to something more subtle. So, you know, these are fairly clear cut. And one thing to keep in mind is that redlining is an intentional type of a thing. The bank intentionally puts its branches where they put them. They then go out and they attract loans or don't attract loans, applications, make loans. And what they do or don't do is really what the regulators are going to be looking at. And we'll talk a bit more about that later, because in the Trustmark case, you've got some fairly clear patterns. And these are very much like the other cases. Townstone is different. We're talking about what did they say in this radio informational that goes out to the general public, because that's where they got their applications, as opposed to operating out of branches, which is your classic situation. Banks operate, for the most part, out of branches. We're going to see more about non-banks, I suspect, in the coming years, than we will about banks. Hopefully banks are learning their lesson that this is what they need to do and this is what they need not to do. But you know, it's something. Discouragement is a pretty slippery slope kind of a thing. What constitutes discouragement is more subjective than where do you have a branch and where are the loan applications coming from. So we're going to see what the judge makes of this. Does he think that this is lack of fair notice by using that word in Regulation B to mortgage lenders out there? I suspect that he's not going to find that, but anyone can make a prediction, right? Let's go to the next slide. Now, will we see more enforcement actions? That's really the question here. You would say with the change of administration, of course we will. Well, what have we seen so far? The first one of the new administration was Cadence Bank, where the bank avoided lending to non-minority areas in Houston. This was not just consumer redress, although there was plenty of it, for 5.4 million, but also the OCC imposed a $3 million civil penalty before the case was referred to the Justice Department for prosecution. That was the first shot across the bow, if you will. Along with the Trustmark case, which we're going to be talking about in a minute, the Civil Rights Division announced something new, a combating redlining initiative. Now, what was new about it are these bullet points. They're going to work with U.S. attorneys' offices across the country. They call that a force multiplier. Typically, these cases come out of Washington. The Civil Rights Division of the Justice Department uses their people. They have decided that they're going to get some more troops on the ground out there. I'm not sure what the local U.S. attorneys' offices are going to be doing that the Justice Department in Washington can't do or hasn't done. We'll find out. They're going to expand to non-depository institutions. This is new. They're going to strengthen our relationship with financial regulators. I'm not sure exactly what that means. They will talk to OCC, I suppose, more than they have in the past. They will increase coordination with state attorneys general, which means another situation where they want more troops on the ground who are out there beating the bushes to look for things. We have seen that occasionally in past years. We certainly have not seen it in recent years. So let's go to the next slide. I call this one a case study. This is the one that came down in October. Another horseshoe-shaped CRA pattern in Memphis. What does that mean? If we go quickly to the next slide, this comes right out of Exhibit A to the complaint that was filed in October. I don't know if you can make out all of the detail. Those little wiggly lines are census tracts. The dark red area is more than 80% minority in metropolitan Memphis. The orange ones are 50 to 80% minority areas, which is a rather large amount of space for the metropolitan Memphis area. Where are the branches? Well, these are these little bank symbols, okay? And they have comments about those in the complaint. Do we see much of anything in the red areas? No. Do we see much of anything in the orange areas? No. They tend to be in the yellow areas, yellow being majority white. Well, that's one thing. Let's go back to the last slide for a moment. There was more to it than that. It's not just a matter of where are your branches, because how do banks get mortgage applications? They advertise. They make the allegation that the bank focused its advertising on commercial lending in business-oriented publications, or their ads which are sort of general brand building. types of things, talking about what a wonderful place Trustmark National Bank is. They also did not have anybody in a fair lending oversight position until 2018, which is when OCC came in, looked around and said, rather loudly. They just didn't have anybody. This, I think, is fairly unusual these days. Most banks of any size are rather sensitive to this because banks in the past have gotten hit by redlining complaints where they thought they didn't have a problem, and oh, yes, they do. Let's go now to 2 slides down. What happened in the Trustmark case? There's 2 more slides, but we'll get to. Few mortgage applications in majority Black or Hispanic areas, which is on the next slide, if we can take a look at it. This is a very busy slide. And what are these black dots? Well, this is where their loan applications came from in 2014, which was the start of the period looked at by OCC. There's another one for 2018 that looks just about the same, but where are those black dots? If you look at it, well, they're certainly well represented in the majority white yellow areas. There's some in the orange areas, which is 50 to 80% minority. Not an awful lot in the red areas, which is more than 80% minority. And you just look at this pattern and you say, wow, maybe they didn't do a very good job of marketing their services to the people that weren't near their branches. So it's one thing to have the branches located in majority white areas. They could have served these other areas, but they didn't. And that's the important thing. One more, the next one. This is where the mortgage loans were issued. Same kind of pattern. If you just look at the central part of Shelby County, where you've got that little band of majority white areas, that's where the loan application, mortgage loans were issued in addition to mortgage applications coming in. And of course, across the line in DeSoto County, Mississippi, that's very active for the bank. If you just, the contrast between what's south of the line and what's north of the line is rather stunning, and certainly makes the point that the government was making in its complaint. Again, there's another slide for 2018, pattern is just the same. So go back 2 slides, please. Oh, we're there, how about that? I thought we were gonna lose somebody. What else happened? What else do the allegations say? They underperformed peer lenders. In other words, they're not the only bank in Memphis or Metro Memphis. There's other banks, and guess what? They have the same sort of data about that is available, and they looked at the data, and the peer lenders do a better job of serving majority Black and majority Hispanic areas in Metro Memphis. There was a fair lending examination by OCC in February of 2018, which resulted in referral for prosecution to both the CFPB and the Department of Justice Civil Rights Division. And 3.5 years later, we get a complaint and consent order after they have worked it up and negotiated with the bank. And so we get a $4 million loan subsidy program to promote lending to the minorities, a $5 million civil money penalty with a credit for the $4 million that OCC had already penalized them by. So a fresh $1 million going to the CFPB for the work that they did on this one, I guess. Well, this is significantly different from what we saw in the prior administration. If you'll recall the previous slide, the couple of items we had there were distinguished by no civil money penalties. That, I think, is going to be a thing of the past. under the current administration, because if they find a pattern like that, they're going to do something about it. So we have Trustmark. This is something that I think is going to be one that we'll see in the future as they look at more banks and find problems. One can hope that the banks do have fair lending oversight. Not all of them do, I'm sure. Bigger ones do, smaller ones may not. One we saw a couple of years ago was the one up in Minnesota, where the Klein Bank was the eventual settlor with the government. And you know, it's going to be interesting to see what happens with this new initiative, where you've got the attorneys general and the local US attorneys going out looking for things, in addition to what OCC does in its regular examinations, or the CFPB does for larger banks. We may see more of this. Let's go to the next slide for just a moment. Okay, and two more. There. I came across a news report about this case. Now, this is not a government case. This is a Black loan officer at US Bank who was fired. He was the only Black loan officer there, and he brought a case against the bank claiming a hostile racist work environment, as well as age discrimination against him because he was 55. And in that complaint, there are a lot of allegations that the bank redlined indirect auto lending in the Chicago area. In other words, the auto lending was also pitched away from minority applicants, according to him, as a whistleblower. So he's claiming a civil rights violation against him, not against the people that didn't get auto finance. And will this attract the attention of the regulators? I think this one's going to be interesting in the future to see if there's something going on in redlining for indirect auto lending, not just mortgage lending. I've been working with auto lending over a number of years, and this is one that's kind of new because we have seen discrimination claims, not so much redlining as charging too much. In other words, what's been known as reverse redlining, which is targeting minorities for high cost lending, as opposed to simply denying them finance. So I think that if we go, I think Trip, we have time for a little bit more discussion? Hello, Trip?
Yeah, we do. Yeah, we do.
Okay. Okay. You were going to be firing questions at me, and I've been doing all the talking here. What do you think we need to advise our audience to be on the lookout for?
Well, I'm really interested in the non-bank, you know, where the redlining cases will go, or even in the pricing that you mentioned with respect to auto lending, whether you know, we have these non-banks. It's one thing like with Townstone, where the argument is that they discouraged certain individuals and areas within their MSA, or people within their MSA. But I also wonder if we'll see investigations or claims about higher prices, you know, through that sort of reverse redlining.
Yes.
And so you know, I think that case with the individual against US Bank is going to draw some attention, certainly.
Yes.
You know, and but I'm just wondering, what are your thoughts on this idea of increased pricing, especially given now with the interest rates so low? You know, whether or not this gives some lenders an opportunity, which they shouldn't take, but an opportunity to increase costs in minority areas.
Well, we've seen an awful lot of claims about that over the past many years, really. And most of these are situations where it's a disparate impact claim. In other words, the targeting or reverse redlining has a disparate impact on minority borrowers because they're being charged more. And then you get into all sorts of things about, is this justifiable, et cetera, the three-factor test that has been argued about so much and has been the subject of innumerable versions of a final rule from HUD with respect to mortgage lending, which gets another very complicated issue involved. Will we see more of this? I think we probably will, because those who bring these claims are probably going to be heartened. What we've seen in terms of mortgage lending are a lot of actions that were either brought by or worked up by the National Fair Housing Alliance. A number of cases have been filed in recent years by them because the government wasn't, among other things. But all of the municipal fair lending cases that I've been writing about for years have been going back and forth to the US Supreme Court, involve more complicated things like targeting claims, which really got a lot of motivation, if you will, from the foreclosure crisis 12, 13 years ago. And somebody wants to do something about it, whether it's the city of Cleveland, the city of Miami, et cetera, et cetera, et cetera. That's where a lot of the emotion has been, and a lot of the smoke, if not fire, has been. You know, I've been chronicling this for a long time in our annual surveys in the Business Lawyer. It's fascinating because it's so complicated. Redlining is a lot simpler. If you look at those charts, those maps, you can see the thing right in your face. Once you get the data collected, plot it out, and that's something that OCC, CFPB, Department of Justice can do and have done for a long time. Targeting is more subjective. You know, is it an unfair pricing or not? So it's something that we're going to see more of, I suspect, but you know, time will tell, I guess, is words of wisdom that I would leave for that one. We'll see how it plays out.
So I have another sort of related scenario, or not scenario, just sort of a concept. So we know that there's been over the past few years, especially because of or primarily because of the coronavirus and so forth, you know, certain forbearance on foreclosure, and that's leading and should lead into potential mitigation activities, refinancing perhaps. And I'm wondering if the same concepts in terms of redlining could be applied where you have lenders, again, this is just a scenario, but where the lenders are within a geographical area, and they have a group of borrowers, or you know, and this is of course where they're servicing their own loans, and they have a group of borrowers, and for the whites, they're bending over backwards to find out ways to mitigate their deficiencies, their defaults, and not so much for the minorities, or within the minorities that are a majority within a particular area. Do you think the same type of analysis can be done in that scenario?
I think it can be. I think the data are more difficult to gather and analyze than you have with mortgage originations. Keep in mind that the redlining cases have been essentially about loan originations rather than loan servicing. There have been some cases brought by the National Fair Housing Alliance in its own name, which dealt with a servicing aspect, which is how do they handle REO properties? And the allegations have been in more than one case that they're doing it in a discriminatory manner by neglecting the ones in the majority minority areas while focusing all of their attention on the ones in the white areas. So we do see some inklings of that. In terms of differentials in how you treat people that are looking for loan mods, for example, that's a more complicated thing to do. And are the data there to begin with? That's, I think, a big question because you can't do one of these cases without the data. All of the ones that have been filed so far about redlining or disparate impact rely on a lot of data. I mean, it's a phenomenal amount of information that you need for some of these cases, like the cases that have been brought by various municipal plaintiffs claiming that what the lenders have done has a disparate impact on minority borrowers. It's not just the HMDA data that they collect, but more to it than that. So it's a complicated thing. Whether somebody will take the trouble and time and expense to pull that kind of information together, I think, is the limiting factor. Private plaintiffs aren't going to do that, I don't think. One person, a single plaintiff, is not going to bring that kind of a case. A municipal government might. We've seen some of that in the past. The National Fair Housing Alliance is out there. I'm sure they're looking into that. But you know, their resources aren't infinite. We'll find out.
Yeah, I think you're right. I think that the data sets that need to be analyzed are much more subjective. And it's, we're gonna, John Redding, I think, is gonna, in our next panel, is gonna talk a little bit about what those data points, data sets could look like in order to make that determination. But certainly it is subjective in the front end, but you know, it could also be rather objective. And I won't steal John's thunder or that part of the next presentation, but I do think that in the future, we could, one of the data sets or data points could simply be foreclosures. And if you look at the foreclosures that are occurring for those who are coming out of that deferment and see whether or not if you look at the whole universe, and if you see that foreclosures are happening in and around majority minority or minority majority areas and not so much elsewhere, maybe that's a starting point for the analysis. You know, and again, we'll also, luckily we have Marta Campos from DOJ on, and I'm sure she can't delve too deeply into that, but certainly maybe I'll push her a little bit to see what she thinks on that on the next panel. So, John, one of the things I'd like to, as a takeaway, do you have a takeaway on where you see, you know, state regulators and state AGs working together, what that might look like in the next couple of years during this administration?
It's going to depend a lot on who is the Attorney General and of what party. We've seen that in the past. We're going to see it some more. Everything is very partisan now. So I cannot possibly see a Republican state Attorney General having much interest in something like this. Pennsylvania has been active in the past. Illinois has been active in the past in this area, although it's really something here, something there, nothing across the board. I don't know that necessarily having a Department of Justice Civil Rights Division initiative will change that much, but if you have a Democratic Attorney General in the state who has the budget for doing something, this could be a call to action that is answered. Other places, even with a Democratic Attorney General, it might not be answered because they just don't have the funds. and the forces to put something like this together. Perhaps they can find something and hand it over to the Civil Rights Division and say, run with it. We'll find out.
And did you find, switching gears a little bit, did you find it at all interesting that in the Memphis case, it was the OCC as opposed to the DOJ who took the lead on that? I mean, I understand that they were parties to it, but it was really the OCC who took the lead.
Well, this is common, actually. The information comes up because the OCC has done an examination, one of its regular examinations, like the Trustmark case, and they say this is bad stuff, and then they give it to DOJ. They refer it. A lot of what the DOJ has done in the past has been a referral from another agency like the OCC or the FDIC. They do examinations too. The raw material for an enforcement action often comes from another agency. Now, can it come from a state attorney general? Occasionally. Can it come from a local US attorney's office? They aren't going to be looking at bank data like the OCC or the FDIC will be doing, or the CFPB for the very large banks. So, you know, it's always a matter of where does the data come from to put one of these cases together. This is rather typical. What you saw in the slides for Trustmark is data collected by the OCC, and they do it for any bank that they look at if they think that there's something that needs looking at.
Great. So we're closing in on the 45 minutes. I would like to open it up to any questions from the audience. You can either type them in or you can unmute and fire away. Well, John, you did such a good job. You answered all the questions before they were even asked.
Or they're not awake yet. I don't know. We'll see. Hopefully we woke up somebody out there.
All right. Well, John, I appreciate it. And I think we're going to move on to our next panel. I know it's a little early, but I think that'll be fine. And again, John, thanks so much, the Dean of the Bar here on fair lending. So our next panel, current state of government investigations and enforcement. As Ryan said, I am the co-chair of the Consumer Financial Services group here at Saul Ewing, and we are lucky enough to have nationally known John Redding, who is a partner in the Consumer Financial Services practice group of Alston Bird, and equally as excited to have Marta Campos, who is the regulatory coordinator for fair lending in the Civil Rights Division of the DOJ. So welcome both of you. I will kick it off. I believe that Marta will start, and we're going to talk, I think, at first, Marta, about that initiative that John mentioned in his presentation. So please feel free to kick it off.
Thank you. Thank you so much. And thank you for having me here. I am going to talk about the initiative. It'll be hopefully of interest to you to hear it from a different perspective. But let me just place the initiative in the context of what our role in the Civil Rights Division is in terms of fair lending enforcement. We bring fair lending lawsuits under two statutes, the Equal Credit Opportunity Act and the Fair Housing Act, and we can bring them jointly or separately. Equal Credit Opportunity Act gives the Attorney General the authority to bring a suit against any creditor in connection with any credit transaction. So credit card lending, mortgage lending, auto lending, any kind of origination and extension of credit is covered. We also bring fair lending cases under the Fair Housing Act when they involve home lending. And home lending is defined to include refinances, home improvement loans. It's not just a home purchase origination. Within the Department of Justice, it's the Civil Rights Division and my office in particular that handle those. As it has been suggested, some of our cases are based on referrals from bank regulatory agencies, but we do exercise what we call our self-starting pattern or practice authority under both FHA and COA. We conduct annual HMDA screening, just as bank regulators do, to look for lenders whose performance makes them an outlier in the market in whatever way. So let me just talk briefly about redlining. So Attorney General Garland announced the Combating Redlining Initiative in October. And from our perspective, it's designed to bring additional resources and strengthen the interagency partnerships to identify redlining issues and to bring enforcement actions when appropriate. Likewise, Kristen Clark, the Assistant Attorney General for Civil Rights, has also said publicly that redlining is a priority for the department because it continues to be an issue that we see. To follow up on what has been said, yes, there is an effort, and the design of the initiative is to partner with U.S. attorneys' offices across the country. We really do think that they can inform our investigation from the beginning with their local expertise and with their knowledge of the credit needs of the local communities of color. And for sure, the initiative and the way forward is going to be that the department is not just focused on depository lenders, but we are expanding our targeting and our review of HMDA data to non-depository institutions. We understand they're not traditional banks. They don't have typical banking services, but at this point, they originate the majority of mortgages in this country. So we are looking at that. And we do work very closely with the bank regulatory agencies. It's not necessarily transparent out there, but the initiative is meant to strengthen that, as well as to strengthen our coordination with state attorneys general. Now, on the substance of redlining, within and outside of the initiative, I just want to mention two things that I think are key, hopefully for this audience and anybody interested in fair lending compliance. First of all, every lender can measure their fair lending risk on redlining the exact way we do it. If you look at our past complaints, it's very clear what we view as evidence of redlining, and you can look at those same factors for yourselves or for your clients: branching, advertising, the CRA assessment area, and a typical shortfall analysis. I think our analysis of HMDA data is also pretty well understood in the industry. And if you study our complaints closely, you see what evidence we provide of the analysis we do. And we take the same approach bank regulatory agencies take. The second thing I want to say about redlining is that it is possible. We have seen lenders that mitigate the risk and turn the numbers around pretty quickly. For example, having branches located in minority neighborhoods, having loan officers that generate applications, that actively seek to generate applications in those neighborhoods, is a very effective way to make sure the lender is providing access to credit to all neighborhoods in its assessment area, not just some. And that likely will change the number of applications a lender receives from those areas in pretty short order. I think also the department's past consent orders, all of which are on our website, are a great resource for compliance measures that we have used in the past and that we know are effective for remediating past redlining. We take compliance very seriously, and so we learn post-settlement how our settlements are being implemented and what is working and what has to be tinkered with. So on redlining, I would say the bottom line, yes, high priority area for DOJ and for all the other regulatory agencies.
Thanks, Marta. Well, I want to sort of circle back to and see if you can comment on the idea of discouragement. I mean, when we have data sets, data points of where the loan is.
Sorry, there was a break. Yeah, there was a break in the line.
Sorry, can you hear me now?
Okay, yes, I can.
Yeah, I just wanted to see if there was a comment or two you could provide on the issue of discouragement, that notion. And I wanted to just preface that by saying I understand the data points, loan origination, where the loan actually closed, as good data sets for the typical redlining case. But is there anything that you can comment on with respect to the notion of discouragement in terms of other subjective activities, such as advertising, such as the number of minority loan officers, things of that nature that maybe the DOJ is going to start looking at?
Well, certainly I cannot tell you what the DOJ is going to start looking at. I may not even know it myself. But beyond that, I think every bank is different. Every bank has a different market. I cannot possibly tell you, oh, yes, X number of loan officers would meet a threshold or not. There isn't that kind of a possible test to test it. But at the end of the day, everything funnels into those 4 prongs that I have mentioned. They are in all of our redlining cases. And when they're not in our redlining cases, it is because it's an acknowledgement on the part of DOJ that there isn't a problem. For example, in Trustmark, there was a discussion about the assessment area. We did not sue Trustmark over its assessment area. If you look at the consent order, there is nothing in the Trustmark consent order that requires them to change their assessment area, as there has been in past consent decrees.
Interesting, thanks. I know we had, in preparation for this, we'd also talked a little bit about you giving some comments regard to other fair lending issues, maybe pricing or things of that nature.
Yeah. So, of course, redlining is a big focus now, but we continue to do our other traditional fair lending work, and that includes discriminatory pricing, discriminatory underwriting in various markets. I think it's important for banks to know that we bring cases where we find them. We're not looking to do it in large metro areas or small towns. What comes up to us that is something that is ripe for DOJ investigation, we investigate. Now, our cases are mostly resolved without litigation. And I think that reflects the fact that the cases we bring, I think, are strong on the facts and on the law and are based on legal theories that the industry recognizes. We started our first fair lending case in 1988, and we have filed fair lending cases in every administration since. And I think one of the things that's important is we bring the case both to remedy the past discrimination and to set the stage for the future. Our fair lending cases typically affect large numbers of individuals. Some of the relief in a case of, for example, pricing can be in the form of checks to borrowers who have been harmed. And some of the relief is directed at harmed communities, as it is in the case of redlining, where banks set up loan discount funds to increase lending in previously redlined areas. There is one case in particular that I'm recommending to you only because of the breadth of the claims that are all in one case. And that is our case against the then Bancorp South, which has since merged into Cadence. That case was investigated jointly by my office in the Civil Rights Division and the CFPB, and it was filed and settled in 2016, mid-2016, June, I think. And that case, I'm recommending it because it includes redlining, pricing, and underwriting. I won't say anything about the redlining claim since I have already talked about redlining, but in pricing, our complaint alleges that the lender charged higher interest rates to minority applicants. And we allege that these disparities were not tied to the creditworthiness or other objective criteria of the borrower, but was instead related to the race of the applicant. We also included allegations of discrimination in underwriting. We allege that the bank had a policy that was intended to deny minority applicants at a faster pace than those from similarly qualified applicants. There is, if you look at our press release on that, there's information that we had an audio recording where a manager is heard instructing an employee to deny applications to minority applicants within a period of 21 days, which was not the same for non-minority applicants. So, I mean, we have brought multiple cases. We have brought cases against captive and indirect auto lenders. We have brought cases against, we have brought a case against a depository lender involving sexual harassment. I mean, we have a breadth of cases that we have brought in the fair lending area, but I'm recommending Bancorp South as one that distills a lot of information into one complaint and consent order.
Great. I know we also talked a little bit about something new with the SCRA and its coverage, and I thought maybe you could comment on that as well.
Yes, I understand that some of you in the audience work in the SCRA space, and SCRA stands for Service Members Civil Relief Act. It's an important part of our lending work. It's a statute that's designed to ensure that there are special protections to service members, from, for example, having their home foreclosed or their car repossessed while they're in active duty and unable to really focus on defending against those actions. And the statute also has a section that provides interest rate benefits on certain obligations that were incurred prior to military service. Generally, the statute covers active duty service members, though not exclusively. There are some parts of the statute that cover, for example, veterans, but the bulk of the statute is for active duty. The bulk of the protections of the statute are for active duty service members. And the coverage typically begins on the date the service member enters active duty. So I had mentioned to Tripp when we first talked about this that on the student lending space, there had been a change. And the change actually, Tripp, when I went back to look at the actual date, harkens back to 2008, but still in my mind, it was the most recent change. So service members can request a 6% interest rate cap on their pre-service financial obligations. It's very clearly set forth in the statute what they have to do. They have to give written notice. They have to provide copy of their military orders or what the statute calls other appropriate indicator. In preparing for today, I found, for example, there's a time when a letter from the commanding officer was deemed sufficient. And then the last thing they have to do is they must give the creditor notice within 180 days of the end of the active duty military service. So if those three prongs are met, the creditor then must forgive any interest rate above 6% for the period of that active duty. And by interest, it's defined to include service charges, renewal charges, other fees, everything except for what can be considered bona fide insurance. And then they have to forgive the interest rate retroactive to the date on which the service member was called to service. So it harkens back, but they have 180 days after the end of it. And lastly, the lender is prohibited from accelerating the principal. So if you're forgiving, say, $1,000, the monthly payment cannot go down by that amount. It has to, you cannot accelerate the principal. So that initially applied to every lending except student lending. But in mid-2008, President Bush signed a statute called Higher Education Opportunity Act. And under that statute, it expanded those protections to service members under the SCRA.
Great. Yeah, I think that's helpful to know, even though that it's not as new as we thought it was.
No, sorry about that.
It's still worthy of comment. Now, I know you talked a little bit about the initiative, and you talked a little bit about the and as that relates to your interagency collaboration and so forth. But I thought maybe the audience would also be interested in just to sort of hear your perspective on how the DOJ works with entities such as the FDIC and FTC in terms of referrals to the DOJ, what you need, what you would do if you were going to let them go ahead and if you were going to take the referral and start the investigation, and maybe juxtapose that with the CFPB's broader authority.
Sure. So under the Equal Credit Opportunity Act, it's the enumerated agencies that must make referrals, the language is shall, must make referrals to the Attorney General are the OCC, the Fed, the FDIC, and NCUA. And CFPB, of course, was not in the mix when the statute was first enacted. All of the agencies have administrative enforcement authority under ACOA. And the agencies generally conduct their fair lending reviews, whether they're about redlining or not. And then if they find, and the standard is reason to believe that a discriminatory practice has occurred, then they must refer to DOJ. All agencies fall under that. The CFPB stands in slightly different shoes because they're the only other agency that, like DOJ, have a COA enforcement authority to go to district court. If you look back at the history of the CFPB referrals, there are a number of referrals, and you would have to admittedly look at each year of our COA report to Congress, which are all posted on our website, and do the math to see how many referrals the CFPB gave us versus what went out the other side of the door. The CFPB has given us referrals that we have deferred to them for administrative enforcement. The CFPB has given us referrals where the two agencies have jointly opened an investigation and then brought an action together. Hudson City is an example of that. And then there are other matters where the CFPB has given us a referral. We have kept it without joining them in an investigation and brought our own enforcement action. Cadence and Trustmark are, for example, recent examples of bank regulatory referrals. Both were referrals from the OCC to DOJ, where we have received the referral, investigated, and brought actions. First Merchants is an example of a case that was started by our own in-house review of data and was not the subject of a referral. So every referral can take one path or another. Many years ago, at this point, probably close to 10 years ago, DOJ made a commitment to the regulators to, when we receive a referral from a regulator, to make a decision as to whether we are deferring to the regulator for administrative enforcement or whether we're opening an investigation within 60 days of the referral being at DOJ. And that is in an effort to streamline the work. And we have largely, and by largely 99% of the time, I think, met that standard. So we have principles for collaborative work that are in place and that we follow. And we work closely with the regulators, not only on those matters that they have referred to us, but also on the ones that DOJ initiates on its own starting pattern or practice authority, because we consult with them, we tell them where we're going. And so there is a lot of coordination that's not necessarily in the public realm. We also meet with the regulators to discuss not only specific matters, but overarching trends. And all of that helps ensure a consistent approach for fair lending enforcement. Just for a second, outside of the context of bank regulatory agencies, we also work with HUD, HUD being the agency that's in charge of investigating matters under the Fair Housing Act. And they refer matters to DOJ under mostly two channels. One is if they have investigated a matter and issued a charge of discrimination, and one of the parties involved elects to have the matter resolved in district court, that would come to DOJ and we bring the action in district court. And the other scenario that is common is when the Secretary of HUD has initiated an investigation, a complaint, and they have investigated the matter systemically, and it, in their view, amounts to a pattern of discrimination, they can refer those cases to us. And lastly, the FTC, which is an agency charged with consumer protection matters, is also a partner in ensuring fair access to credit. The difference with the FTC is they do not need to have discrimination as part of their evidence. Just straight up consumer protection is what they do.
That is super helpful, and I appreciate that, and I'm sure we all appreciate that overview. And we're going to move on to John now. You can move the next slide. But Marta, I want to suggest to you that if you have any general comments regarding anything that John and I say, please feel free to jump in. I know it won't be very, it won't be. Yeah, that's where you should be looking at. Yeah, we're going there next. I understand that, but perhaps if there is a DOJ fair lending perspective, please feel free to raise that or indicate it, because I know our audience would be very interested in that. And again, so thank you. So next we're gonna move on, and John Redding from Alston Bird is gonna talk a little bit about some various areas within consumer financial services and consumer protection. We've moved on to the next slide, and you can see that. So John, I'm going to turn it over to you, and you can start with FCRA.
Great, thanks, Trip, and thanks everybody. It's nice to be here and talk with everyone. I'm going to move through these relatively quickly. I know that we don't have a lot of time. I'm not going to focus as much on what DOJ is doing, though that is interspersed in here, and I'll touch upon it briefly, but rather thought I would spend a little more time on what we're seeing, particularly out of CFPB. You can see we'll talk about AGs and the OCC as well. On the Fair Credit Reporting Act front, I think everybody is probably aware that the Bureau, the CFPB, has been looking at credit reporting for a number of years. I think every once in a while I get the question, when in the world are they going to move on to something else? Quite frankly, I don't think it's anytime soon. I would say most of the investigations that I have, probably the majority, are in fact credit reporting related or have credit reporting as part of them. Similarly, clients that we work with on the examination front, so within the supervisory context, also credit reporting seems to be an active area. I think if you look back at consent orders, if you look at the examination handbook relative to credit reporting activities, you can get some really good insights into what the Bureau is focused on. And I don't think we're giving away any secrets here. They continue to be hugely focused on policies and procedures. And if you look, every consent order that I can recall in this context of fair credit has said that the company lacks or has failed to properly take into account the guidelines set forth at Appendix E to Regulation V as in Victor, as to steps they're required to take or activities they should undertake to ensure the accuracy of the information being reported. And so one takeaway that we generally give to clients is go map out the requirements under Appendix E and just check them against your own policies and procedures. Make sure that you've done that, because it's interesting within the context of both supervision and enforcement, being able to go back when you get that PAR letter or NORA letter, PAR being when you have a supervisory quote threat of enforcement, NORA being in the context of an investigation where they're threatening enforcement. It's always interesting to be able to go back and say, look, here's what we've done. But as I say, every one of these seems to have a claim of inadequacy. The other areas they're very interested in are what are people doing relative to Metro 2 file, both pre and post submission, to QC the file, look at reject reports that you receive from each of the consumer reporting agencies to whom you submit a file, etc. And then I think lastly, I will tell you that disputes are they continue to be a huge component of these investigations and examinations. And it's not just, are you looking at everything that's within the dispute itself, or are you looking at all the materials that have been submitted with the disputes, but they're going a little bit further of late. They're actually suggesting that when, for instance, you get a dispute that is not his/her, so code 001, that they think you should be looking at the underlying contract itself to see, was it signed by this person, et cetera. That to me is, I think, a bridge too far. And we have consistently pushed back on these kinds of things, but nonetheless, it's indicative of the kinds of activities the Bureau is looking at. When it comes to military lending, as Marta mentioned, SCRA, the Service Member Civil Relief Act, DOJ, very active. One of the things to keep in mind here, pay special attention to your service member customers. DOJ, when it comes to SCRA, and perhaps unlike anything else we deal with, a single complaint will generate an investigation, period, full stop. And the number of times that we've seen this is staggering. Ryan DiClemente and I actually worked on a matter together. I had the enforcement, he had the litigation. Single customer complaint drove an entire DOJ investigation. I can tell you the last 3 investigations I've been doing or am currently doing were exactly that. So something to be aware of. The other thing to note is the Military Lending Act. Pay attention to it. And I would commend to you, if you want to get any indication whether the CFPB is serious about the Military Lending Act, they've recently filed a litigation against a company called First Cash. It's going to be an interesting piece of litigation I happen to be defending. And it's a standard Military Lending Act type of claim where they are basically claiming excessive rate, inclusion of an arbitration provision, which is prohibited under the Military Lending Act, and failure to provide certain disclosures that are required. What I would tell you is take a look at how you confirm that a consumer is not a covered person under the Military Lending Act to the extent you are in the origination business. And then also, note the safe harbor. There is a Military Lending Act database that you can bounce up against. Obviously, over the years, we've all heard the anecdotal and seen some evidence that the DMDC database may not be entirely accurate. But again, recognizing that this is a safe harbor. So whether the information is right or wrong, if you've checked, you can rely on the result.
John, we're running up a little bit against the timeline. I wanted to, maybe you could either pick debt collection, disparate practices, or the OCC consent order with Cenlar to finish up on.
Okay, why don't we pick OCC Cenlar? I think that's a good one because there are some good lessons that come out of this. So as I'm sure people know, in October of this year, there was a consent order entered into between the OCC and Cenlar. I'm not going to walk through the facts or the findings of that. Quite honestly, you can read it. It's available through the OCC's website and available online. But when you look through it, you'll note that within the consent order, and there are a number of areas that are enumerated where in the findings section, and then also within the steps that were imposed or agreed to by Cenlar with the OCC as to things that they will be doing. And so certainly commend you to look at this because those are areas that the OCC is obviously interested in. But let's talk about the lessons learned. I think first and foremost, this is, and I have no doubt, I don't work with the company, but I have no doubt they would tell you that they worked hard to address the issues that the OCC had initially raised, recognizing that the OCC has stated part of the reason for this follow-on is because of basically not taking timely action in response to concerns. I am sure the company would disagree with that, but nonetheless, I do think it is certainly a very good lesson to be learned that when a regulator, regardless of who you're talking about, is telling you things that they are concerned about, it is very important to focus on those issues and address them as quickly as possible, keeping the regulator informed to the extent you're able to. I think the second area, and this is again a broader takeaway from it, is be sure that you are monitoring for or to ensure that you are providing appropriate risk management and compliance resources within your organization. You want to be testing your controls on a regular basis. You want to be monitoring existing practices, particularly in light of growth. As you are growing, the complexity increases. The risk to consumers can be viewed as increasing, making sure that you're monitoring what's going on and that your policies, your procedures, and your practices are all working. You think about the compliance management system. What do we want? We want preventive and detective controls. I want to prevent harm, but when things happen, I want to ensure I have processes to detect it. And when I find it, I want to have policies and procedures to remediate. And so I think just making sure that we are always looking at these issues when going through growth is key. And then being willing on an expedited basis as needed to update whatever controls, and then finally making sure that we have oversight at senior levels within the organization, and importantly, a feedback loop, making sure that when something is reported up, identified as an issue, and then directives to fix are completed, that there is in fact a robust feedback loop to ensure, one, that someone is responsible, and two, that senior executives and the board, to the extent they are directly involved, are made aware of when those issues are resolved. And so I think those are some great takeaways from that order. Again, I don't think there's anything magic about them, but it is a very good indication based on the content of the consent order of things to be paying attention to.
Thanks, John. That's super helpful, and I know people on the panel when that order came out, we're looking at it very carefully. So thanks for both Marta and John for their time. I let the time get away from me a little bit here, so I apologize to all of you and to the speakers. We're going to move on now to our TCPA litigation panel. That is going to be provided by Colleen Fox and Zach Miller. Colleen is an associate here at Saul Ewing, and Zach Miller is a partner in the financial services group of Burr and Furman. So I will turn it over to you guys. Take it away.
All right, thanks. Colleen, can you hear me?
I can hear you just fine. Hi, everyone.
All right. I really appreciate, I just want to state from the outset, really appreciate being invited to speak with Colleen. And I just want to thank Ryan for the opportunity to speak on the TCPA. Colleen and I have been kind of going back and forth about some of these, developments that we've kind of been seeing or expecting for many years. I think since the TCPA litigation started taking off in 2008 to 2010, we've been expecting some sort of definitive ruling regarding what technology is actually covered by the statute. We finally got that in 2021, and it was from the Supreme Court. So I think for a lot of years, we thought it was going to be from the FCC, but that didn't happen, or at least they tried and were unsuccessful. And so that's really the theme of the presentation: is TCPA not dead yet, even after the Supreme Court ruling? So if we go to the next slide, this is our agenda today. We're going to go over the Facebook decision really quick. I'm sure a lot of you have read it or are already familiar with it. The fallout then from Facebook, which is probably the most important. How are folks in the plaintiff side and the defense side responding to the decision? And then really, how are they attacking them at the pleading stage? And then that tricky footnote 7. And then really, what's the future for the TCPA? How much does it have to be part of your business plan from here on out? Your litigation budget? That's the question that everybody has. So we'll go over pre-recorded calls, do not call claims, ringless voicemails, which I get questions about regularly, and then just what we're seeing on the state level, particularly the new Florida robocalling statute. All right, to the next slide, just quickly, what happened this year with the Facebook decision is really we're looking at kind of a small but very important provision in the TCPA. It's that dealing with calls made by an ATDS, an automatic telephone dialing system. There are portions of the TCPA, including the do not call provisions that Colleen's going to discuss, and the robocalling provisions where it doesn't matter what type of equipment you're dialing with. But if you're talking about calls to cell phones for a servicing purpose, which most of the folks on this call would be interested in, the definition of ATDS is incredibly important. It's equipment that has the capacity to store or produce telephone numbers to be called using a random or sequential number generator, and then to dial such numbers. And the dispute regarding this definition really comes down to, if you look at subsection A there, it's strange, it's worded differently, but does that modifying clause after the comma, which says using a random or sequential number generator, modify both the words to store and produce telephone numbers to be called, or just one or the other? What's required? All right, so to the next slide. So there are really 4 ways you can interpret this. I'm not going to go through all these, and I think you guys will have the slides. But the 3rd, 7th, and 11th Circuit took a really narrow interpretation of that definition and said, that modifying clause has to modify both. So if you're using a piece of equipment, it has to both store and produce numbers using a random or sequential number generator, not just store numbers and automatically dial them. The other important interpretation is really the 3rd here, which is that the phrase might only need to limit one of those 2 numbers. And in most cases, they decided that it was produce. And so therefore, if a piece of equipment stored numbers and then dialed them automatically, 3 circuits prior to this year held that that was enough. So if you were using a predictive dialer that dialed from a list, or any dialer that dialed automatically, really, you were covered by the TCPA and its $500 per call penalty provisions. Next slide. So what's the importance of this ATDS definition? Our industry cares about predictive dialers. That's how most servicing, debt collection, marketing companies reach their customers. They're not dialing numbers randomly. Everyone's using analytics to try to reach targeted individuals. So they're dialing numbers from a list, but they're using predictive dialers that they can have a bank of employees that are representatives that are on the telephone, and the predictive dialers deciding when those folks might be available and then choosing numbers from a list and calling them. It's not coming up with numbers on itself. The FCC had essentially ruled in the years prior to 2015 that equipment was covered, was an ATDS, because it dialed numbers automatically without human intervention. The DC Circuit invalidated the FCC's prior rulings in 2018. That left a void, and the circuits filled it and they split. Next slide. And that was all till our friend Sergey Limberg came along in 2017 and made the very bad decision to sue Facebook on a very bad set of facts for him, which were texts that generally all of us would appreciate getting. So the Facebook case was about a text that said, look, someone else has logged onto your account. Click here to, get more information on what happened. Really being told of potential identity theft is something that generally is appreciated and important. But his position was, well, because a human being didn't type this in and text it to the recipient, it counted as being an ATDS text. Next slide. So what happened is the district court basically said, look, his conclusory allegations were insufficient to survive a motion to dismiss, but the Ninth Circuit said, well, actually, he's alleged enough. He's alleged that Facebook has a database of numbers that dials those numbers automatically, and that it even automates the aspects of the messages that appear personalized. Thus, stored numbers from a list and dialed them automatically counts under the ATDS definition. Next slide. So the 1st of April, the Supreme Court came in with the Facebook decision and said, really, the question here is that sticky definition and what equipment is necessary to be an ATDS. Does it have to store and dial automatically, or does it have to store using a random number generator and dial using a random number generator? And the Supreme Court held was a narrow interpretation of the statute, that it really has to do both types of functions in order to qualify as an ATDS. Next slide. And so really what the Supreme Court used was kind of just a statutory interpretation rubric. I mean, they said, when they look to the series qualifier canon. When there's a straightforward parallel construction that involves all nouns or verbs in a series, a modifier at the end of the list normally applies to the entire series. So really they said, we only have to look at the text of the statute to determine what equipment constitutes an ATDS, something that the FCC had thought was impossible for 21 plus years. Next slide. Really interesting though, and something that still really hasn't played out, is the Supreme Court kind of sidestep the issue of capacity. If you go back to that definition, it's the capacity to store or produce numbers using a random or sequential number generator. That's in the definition. And twice in what would be potentially considered holdings, the Supreme Court left out the word capacity altogether. So it said, because Facebook's notification system neither stores nor produces numbers using a random or sequential number generator, it is not an auto dialer. They didn't discuss what its capacity was, though. And again, then they talked about Congress's definition, and there's no mention of what the capacity of a system would be. Next slide. There was one reference at the very end of the opinion when, it left it out there for plaintiffs' attorneys, to argue, and they went back to really the text of the statutory definition. They said the importance is the capacity to use a random or sequential number generator. So that, left open the question of capacity. Is it still there? It definitely is still in the statutory definition. And are there going to be arguments about that? If you go back to prior to 2015, when the FCC's order came out, it was really that capacity word that was the subject of a lot of litigation. How much modification to a system that currently cannot be used as a random or sequential number generator would be required to give it the capacity. Every technological device has the capacity, essentially to be modified. My mouse could essentially be put into a system that becomes a random or sequential number generator, but how much work is required in order for that to be done? Is taking your cell phone and downloading an app, is that enough that it could be considered to have the capacity to be a random or sequential number generator? That question is kind of still out there in the open. Next slide. All right, Colleen.
Thanks, Zach. So while the Supreme Court in Facebook finally put an end to the longstanding circuit split on what constitutes an ATDS, there still has been plenty left for the district courts to hash out. Here's some issues that Zach and I have identified that are kicking around in the lower courts now. So as Zach mentioned, there's this capacity issue, the capacity to use a random or sequential number generator to either store or produce phone numbers to be called. The capacity angle is, I guess, not surprisingly, being leveraged by plaintiffs' attorneys to try to avoid motions to dismiss. With respect to predictive dialers, the good news is that that argument has generally been unsuccessful, but I'll talk more about that in a minute. Plaintiffs' attorneys have also latched on to footnote 7, which Zach will talk more about. But the argument is that footnote 7 suggested in dicta that randomly or sequentially selecting numbers from a predetermined list might qualify as an ATDS. Zach's going to talk about how that's playing out in the lower courts. We also posed the question on this slide, now that the ATDS issue has been resolved, is there going to be an increase in other types of TCPA claims? So things like pre-recorded artificial voice call claims, do not call list claims. Spoiler alert, I think in both of our experiences, the answer to that question is definitely yes. Will other new technologies, as they start to evolve, be covered by the TCPA? And last, are states and federal governments going to step in to fill the void that was left after Facebook resolved the circuit split? So next slide, please. So the good news is that the financial services industry has actually done fairly well on dispositive motions on ATDS claims since Facebook. Of course, the plaintiffs' bar is a creative bunch. They do still have a few tricks up their sleeve. Because of this reference to capacity to use a number generator, plaintiffs are arguing that that's all they need to do to survive a motion to dismiss, that they're entitled to discovery on the capacity issue. I will say courts are kind of split on that, but when it comes to predictive dialers, are mostly coming out in our favor. So for example, one court in Michigan in an action against Ally Financial pretty strongly rejected actually the capacity argument. It dismissed a putative class action against Ally based on its debt collection calls, actually not to the borrower himself, but to his sister. Ally had apparently made live calls to her because there was no pre-recorded claim there, trying to collect her brother's debt. So the case was stayed pending a decision from Facebook. And when that came down, the court ordered the plaintiff actually to show cause, which is a pretty aggressive stance, why her complaint should not be dismissed. In response, the plaintiff latched onto the capacity argument. She said she should get discovery into whether Ally's dialing system had the capacity to use a random or sequential number generator. The court said, no, plaintiff. First of all, even if this particular system actually did have the capacity to function as an ATDS, an ATDS was not actually used to contact you. The court also held, and this is a line that's great from a defense perspective, rather these calls were targeted at specific individuals in connection with specific accounts by defendant. It said that ends this case. So in another case in North Carolina, Bank of America got dismissed, a case involving 300 debt collection calls it had made to the plaintiff over the course of about 6 months using a via proactive contact. So fairly commonly used predictive dialer system. The court held that the Avaya system was not an ATDS as a matter of law, because the numbers selected to be called were chosen from a pre-existing list based on criteria set by dialer administrators and not by random or sequential number generators. I think this case in particular really just goes to show you the impact that Facebook has had on our industry, because pre-Facebook, if you had been hit with an ATDS claim alleging that 300 calls were made without consent, that would have been cause for concern. You would potentially be looking at serious damages. So to have this issue settled, is huge for us. So similarly, and this is the third case down, the District of Nebraska, in this case called Chrome, granted summary judgment in favor of USAA. That case was also premised on debt collection calls made to the plaintiff. The court rejected the plaintiff's argument that the system was an ATDS because it could automatically resequence numbers on a call campaign list. Again, here's the capacity argument again. It also rejected the plaintiff's argument that the system had the capacity to function as an auto dialer because it could maybe be reprogrammed to use randomly or sequentially generated lists of numbers. The court said that because the system did not actually randomly or sequentially generate numbers, and this is another great quote for a brief from Whole Cloth, and only dialed from a list of customers, it was by definition under Facebook not an ATDS. So as I said, the cases really have been pretty positive, at least for our industry. The rub is that there are still some courts that are holding the ATDS issue over for summary judgment. So in this fourth case down, Miles, the Eastern District of Missouri are denied a medical debt collector's motion for judgment on the pleadings. It held that whether an ATDS was used was an issue appropriately left for summary judgment. And unlike the cases we just talked about, it rejected the argument that because the calls were targeted by a debt collector to a specific person, so i.e. the borrower, they couldn't have been randomly or sequentially generated. So when you get past the 12B6 stage, this is where you could potentially get into experts arguing over what a system's capacity is. And, it could be a pain to get to summary judgment from that point. So there's certainly a split with respect to predictive dialers. It's a small one. And I think the issue is more whether courts are willing to decide this issue on a 12B6 motion as opposed to holding it over for summary judgment. But the landscape really has changed, and there's no doubt, I think, that Facebook, gave us as defense attorneys a lot to work with, especially on dispositive motions with respect to ATDS claims. Next slide, please.
So just real quick, I'm going to jump in and, talk about footnote 7. I'll give it back to Colleen. Footnote 7 was something the day that the Facebook opinion came out. I was getting texts from plaintiffs' attorneys that were like, we still have life, right? Like, read that footnote. It describes equipment that could be an ATDS, and it describes a predictive dialer. And upon first reading, it does. And if you don't look any differently, it does give cause for concern. So it says, for instance, an auto dialer might use a random number generator to determine the order in which to pick phone numbers from a pre-produced list. They left out the word sequential there, but you have to read that in because it's in the definition. So is an auto dialer a device that sequentially dials numbers from a list? If so, it's a predictive dialer. And that's what plaintiffs started to argue. It has not been successful though. So the next slide. What you have to understand about footnote 7 is that you can't just read it in isolation. It comes in a part of the opinion where the court is saying, okay, this is what we're doing. We're saying that this modifying clause has to modify both of those verbs. Is there any way that's going to produce an illogical result? And so maybe it's illogical, or potentially could be argued to be illogical, that a device could store numbers using a number generator, right? Why would a number generator store numbers? And what they did is said, well, maybe Congress just wanted to be careful and wanted to make sure that, you know, it was being clear that, you know, a device, you couldn't get out of the definition by going to the phone book, taking every single number in the phone book, and then having a device that just randomly chooses numbers from that list, or load a device with every single potential number from 1 to 9999999, and just have a device that chooses all those numbers. And it said such a device may exist, and it referred back to 1988, before the TCPA was passed, and pointed to a patent called the 028 patent, and kind of described a device that did that basically created a random or sequential list of numbers, and then, you know, put that list to the side, then chose those numbers randomly to dial them. And the court said, you know, that type of equipment would be prohibited. But if you go, this is the right slide, that the courts that these have been argued before so far have rejected this argument, with one exception, and not really. But if you really want to read a good understanding of, you know, you are a defense counsel and you're writing a brief and you want to try to, you know, clarify footnote 7, really go to this Timms case. That's the one I want to point out. An excellent analysis of what footnote 7 means, the proper context. And basically they're saying, look, the major difference between the equipment described in footnote 7 and the equipment that's used for a predictive dialer is that for predictive dialer, the company is providing the list of numbers to the dialer, right? It's saying, hey, here's our customers that we specifically want to reach, just like the case Colleen talked on the motion to dismiss stage, go dial these numbers sequentially. And that's completely different to the type of equipment discussed in footnote 7. All right, back to Colleen, and next slide.
So when Zach and I gave this presentation last year, concerningly for us as TCPA litigators, we predicted that TCPA litigation was going to dry up if the Facebook decision went the way that we thought it was going to. To some extent, it has, at least in our industry. I'm sure many of you have seen that too. Just to put some numbers on it, to put it in perspective, from January 1, 2021 to the end of September of this year, filed TCPA cases are down almost 50% versus this time last year, with only about 1,400 filed through the end of September. So far, that's 2,000 fewer TCPA complaints than were filed in all of 2020. And we think with roughly 125 TCPA cases filed each month, by the time this year is out, the number of new TCPA complaints that were filed in 2021 will likely reach a near 10-year low, which is pretty remarkable. So while other consumer protection statutes are outpacing the TCPA right now, about half of TCPA cases are brought as putative class actions, which obviously complicates litigation. They're always concerning if you're a business hit with a putative TCPA complaint. So seeing the writing on the wall, I think even in the months before Facebook, plaintiffs' attorneys had started to pivot away from ATDS claims, were kind of hedging their bets, and had moved to do not call and pre-recorded message claims. Certainly we've seen an uptick in that since Facebook was decided. So taking the first category of cases, do not call cases, these are plaintiffs who were contacted even though their numbers were registered on the national do not call list, or an internal do not call list. We're seeing these brought in class actions, and definitely by our high volume plaintiffs attorney filers, because they're pretty easy, frankly, to plead. You don't need to allege an artificial voice or ATDS. You just need to show that your number was registered and you received multiple calls. Of course, that also means there's a lot available to us from a defense perspective in defeating class certification, like prior express written consent. There's an existing business relationship exemption. There's also a safe harbor defense, depending on what your policies are. And the good news, I think, for our industry too, is that do not call claims only apply to solicitation to telemarketing calls. They don't apply to servicing calls, efforts to collect a debt. I will say if you're placing customer service calls that potentially have a mixed message or marketing component, do not call claims are very much in play right now. I think the bigger issue for us is going to be pre-recorded and artificial voice claims. Pre-recorded non-marketing voice messages to cell phones still require prior express written consent, and that's regardless of whether an ATDS was used. So, and while litigation in the past, as we all know, really focused on what's an ATDS, what does that mean? Does that cover a predictive dialer? I think that we're going to see the law regarding pre-recorded voices start to be fleshed out a bit. So for example, I'm sure many of you know that the Fifth Circuit a few years ago held that a party's not liable under the TCPA for making artificial or pre-recorded voice calls if the voice does not actually play during the message. So I think we're going to see more litigation potentially in that area. So I think overall, you know, the TCPA might be down post Facebook. It's definitely not out. Now's not the time to go tossing your TCPA compliance policies. Plaintiffs' attorneys are definitely coming up with new and different ways to file these lawsuits. And as we said, some of them are getting past motions to dismiss, although generally the cases are favorable for us. So next slide, and I'm going to turn it back to Zach.
Just real quick, in the last 2 minutes, we'll spend 1 minute apiece talking about these two things. Ringless voicemails. You know, if you ever go to these servicing conferences or, you know, like industry conference where there are vendors there that are trying to appeal to servicing departments, they always have some new type of technology that they say is TCPA proof. One of the ones for the last few years has been this ringless voicemail. Your phone will never ring, but you'll just have a voicemail pop up that has your, you know, creditor, debt collector, marketer leaving you a voicemail message. And what these ringless voicemail companies tell me is that this is a lot more effective than a text message. It's much more likely to be listened to and then responded to. That all may be true. But the conclusion or an analysis that they're not covered by the TCPA is just not founded in anything. The case law that has looked at it so far has said, yes, ringless voicemails are a call. You're still using the telephone dialing system to place some sort of a communication to a cell phone. Right now, though, former Georgia Senator David Perdue has petitioned the FCC to declare that they are not calls, and that's still pending. The FCC sought public comment. There were 2 prior petitions filed before this by ringless voicemail companies that were previously withdrawn. Final slide. And then just, okay, what's around the corner? You know, you're going to hear a lot about this Florida robocall statute. It prohibits telemarketing calls essentially, but it has a much broader definition of an auto dialer than the TCPA has. It's, you know, an auto dialer in Florida is any automated system for the selection or dialing of telephone numbers or the playing of a recorded message. Much broader than an ATDS, could even constitute kind of the point and click systems that a lot of folks use to contact their customers. But again, this is just marketing. It's just telemarketing. So that's really what it's limited to. So that's it for us. We appreciate it. And Colleen, thank you for letting me speak with you. It was a pleasure. And thank you for the invitation to the Saul Ewing conference. It's been great so far.
Thanks so much, Zach, and thank you everyone for your time. If you have any questions, please don't hesitate to reach out to either one of us. And with that, I'm going to turn it back to Ryan. Thank you.
Great. Thank you both. That was really terrific. A great summary of the post-Facebook world that we're all living in. We're going to take a break. But before we do, we have our first code for the CLE, and it is 50301. Again, that's 50301. As a reminder, that code needs to be recorded and reported back to us with the survey. We will come back at 10:45 for our FCRA panel. So thanks very much, and we'll see you soon. right. People are hopefully filtering back in. Welcome back. We're going to go ahead and get started with our next panel, which is our FCRA litigation and regulatory update. Again, for those of you who don't know me, my name is Ryan D. Clemente, and I'm the co-chair of Saul Ewing's Consumer Financial Services Litigation Group. For this presentation, I'm happy to be joined by Jason Bishel, a member of McGlinchey Stafford's Consumer Financial Services Compliance Group. Jason and I have worked together on FCRA issues for years. Jason previously served as in-house counsel and the person responsible for FCRA compliance for an auto finance company prior to recently moving to McGlinchey. So I think his experience provides him with an important perspective on these issues that he's going to share with us. Next slide. So in 2021, FCRA filings have continued to increase. While FDCPA, and we just heard TCPA lawsuits are down, and in some cases down significantly, FCRA lawsuits have continued to increase nearly 5% this year. Now, keep in mind that this year's increases are layered on top of the year-over-year increases we've seen for the past 4 to 5 years. And now these claims continue to make up a significant portion of many financial services companies' litigation portfolios. Personally, these cases have now make up a significant portion of our litigation practice as well. I mean, over the past 5 years, we have seen a real significant uptick in this type of litigation on behalf of a variety of different financial services clients. As Jason will discuss, FCRA continues to remain a central focus of federal regulators and the subject of various enforcement actions. Now, Jason and I could spend the next 2 hours discussing various FCRA trends and different issues, but many of you would probably be passed out and drooling on your laptops by the time that we finished. So what we've tried to do is basically identify a couple specific FCRA claims and decisions that are noteworthy in the limited time that we have. Next slide. So there are a couple different issues that we're going to cover today. The first are a few hyper-technical disputes that remain an area of focus for plaintiffs' counsel. And then we'll dive into a few more substantive issues relating to ID theft and fraud claims. Now, over the past few years, 18 months, I've noticed a bit of a shift in how courts are dealing with these hyper-technical FCRA claims. Previously, courts were frankly confused by many of these technical credit reporting issues and frequently just punted at the dispositive motion stage early on. But recently, I've noticed a shift. As courts continue to get inundated with FCRA claims, they've begun to look a bit more closely at the viability of certain FCRA claims early on in cases and have been much more open to dismissing allegations of hyper-technical violations early on in a case. The first of these hyper-technical claims I'm going to discuss are claims arising out of the reporting of a consumer's pay status or pay rating. Now, for those of you who don't know, the pay status or pay rating is a code that identifies when an account is current, past due, in collections, or charged off when accounts are transferred, paid off, or closed, among other items. So for example, a 1 represents an account that was 30 to 59 days past due when an account was transferred, for example. So simply put, these designations are intended to reflect the status of an account at a snapshot in time when an account was sold, transferred, paid off. However, on a consumer's credit report, these pay status or pay ratings can show up as the number value, or they can show up as 30, 60, 90 days past due in the pay status or pay rating section. Creative plaintiffs' counsel have used this designation to argue that these sections inaccurately convey that an account is currently 30 days past due on accounts that were closed, paid off, or transferred, and is therefore misleading to potential future creditors. So while we have had and still have a number of these cases, these theories are real hotbed topics for plaintiffs' counsel like Dan Zemmel and others. But we've seen some positive trends in favor of early dismissal this year. For example, the decisions listed in the slides below identify a number of recent opinions where courts have dismissed claims based on this pay status or pay rating inaccuracy. And they've done this at a motion to dismiss or a motion for judgment on the pleading stage. And in essence, these decisions, courts have found that when a consumer's report is read in its entirety, and the reporting also shows a zero balance, an account transfer or closure, and a prior date that the account was last updated, the only logical conclusion is that the pay status or pay rating designation is a historic reporting item and doesn't reflect the current state of the account, as plaintiffs' counsels are arguing. The courts are using this conclusion to find that there's no alleged or pled inaccuracy, and therefore dismissing these cases on a motion to dismiss or motions for judgment on the pleadings. Now, there are still cases going the other way, but these cases involve reports or reporting where there is still some other item, such as monthly payment or a balance that was reporting as if it were still open. It's important to note that courts have also denied motions where a full consumer's credit report wasn't submitted for consideration. So in considering to move at an early stage on these cases, you want to look at the entirety of the report to ensure that all items clearly indicate that an account was closed and it's not currently reporting. And be sure to attach the consumer's full report showing these other items to your moving papers. Next slide. Another hyper-technical error that continues to be an area of focus of plaintiffs' counsel is the alleged failure to zero out scheduled monthly payments on accounts that are closed or charged off. This claim has been around for a while. I'm sure many of you have dealt with it, but the defense bar is having success at getting these claims dismissed, particularly at the summary judgment stage. Now, as set forth in the opinions below, the courts are beginning to recognize that the scheduled monthly payment represents the historic scheduled payment for an account and is not misleading or inaccurate when a consumer's report reflects the account was closed and there's a zero account balance. However, the challenge on a motion to, this case is a little bit more difficult to get dismissed at a motion to dismiss stage as reflected in Nelson. And many defendants are holding this issue until summary judgment stage. Next slide. Another more recent technical issue that has arisen and has been the focus of plaintiffs' claims is the failure to report a past due balance and the overall balance as being equal for charged off accounts. Now, if you're thinking, how could a consumer be harmed by such a claim, you're on the right track. While these claims are still early in their development, a number of courts, which are included in this slide, have dismissed this theory, finding the alleged inaccuracy to be, quote, baseless or meritless. And courts have also dismissed this claim on a lack of standing, such that the alleged inaccuracy didn't have any potential adverse effect on credit decisions and presents no real risk of future harm to borrowers. Now, as I mentioned at the outset, these are just a few examples of how courts are beginning to weed out some of these hyper-technical FCRA claims. And we hope this is a trend that we're going to see continue into 2022. Next slide. So next, I want to spend a minute or two talking about an important defense in these cases that I think often goes overlooked. While the FCRA requires a reasonable investigation into disputes involving account and reporting information, it draws a distinction and a difference between these types of factual inaccuracies and disputes which involve legal determinations or challenges. For example, reporting inaccuracies that are based on a legal interpretation of an underlying contract or an agreement or an interpretation of law are not the type of inaccuracies that can serve as the basis for a plaintiff's FCRA claims. The following cases in this slide discuss this important distinction and this basis for dismissal. I think it's important to keep this potential defense at the forefront of your minds as we begin to likely see more claims dealing with the terms and the enforceability of loss mitigation and forbearance agreements. This defense can also be used to potentially defeat claims under the CARES Act, where a plaintiff is claiming that the act required a furnisher to report something other than the actual or true status of the account because of the legal terms or the requirements in the law. Next slide. So I think now is a good time to transition into one of the more substantive issues, which is dealing with FCRA claims that are based in ID theft and fraud. These cases are being brought with a great deal of frequency, and is something that we see in our practice quite often. They're challenging because they can present the classic bad facts case where a furnisher has been potentially missing years of clear indicia of fraud that's on the account, creating real actual damages for borrowers and a real risk of punitive damages for defendants. So we have developed a standard procedure that we use when we get cases involving claims of true ID theft or fraud. And we've also worked with one of our clients this year to bring this process internally and make it part of their initial case assessments that were sent at the outset of a case, which saves them money, and that we're not expending the fees to actually undertake this investigation. I would encourage you to think about your process for dealing with these cases because of this enhanced risk of these cases. The first thing we do is we run a people map or similar search on the plaintiff or victim. This allows you to identify any potential aliases used by a plaintiff, along with any addresses that he or she may have previously resided at. Now, last year, this report actually helped us uncover that a plaintiff, represented by a well-known FCRA firm out of Philadelphia, was actually using a separate alias to claim that her identity was stolen. In effect, plaintiff brought an FCRA claim claiming that she herself stole her own identity. Of course, none of this was disclosed, but needless to say, when it was presented to plaintiff's counsel, the case was quickly voluntarily dismissed. In other cases, we use this report to help us determine if plaintiff lived at a location where the alleged fraudster also resided. This commonly occurs where the fraud is based on a family member or other relation stealing his or her identity. So we next look to the application source in the origination file. Some financial products will be more susceptible to fraud, such as companies that allow for online applications, while others, such as mortgage and auto, may be more difficult to secure by fraud. The next thing we look at is we examine the account for email, primary telephone, billing address changes that occurred at or near origination. This can be a clear indicia of fraud. And we've had situations where an email, a primary email address, was immediately changed to a name clearly not matching the borrower's. Examining call recordings is also a really important piece of evidence to review at the outset of these cases. We recently had a case where a woman called in on behalf of a male borrower's account, and when the representative wouldn't validate the account, the woman claimed that her husband, who opened the account, was deaf and couldn't communicate over the phone. They gave an alternative method for communicating and authenticating the account, which was never utilized. And as you might suspect, the plaintiff, whose identity was stolen, wasn't deaf or disabled in any way. This reporting was missed as part of the fraud review and investigation. We've had other cases where it's clearly a male voice claiming to be a Jane or Joan Smith account holder, and the account was validated and the call continued. This also was missed on the fraud review. These call recordings are important pieces of evidence to review at the outset of a case and can help you assess the risk level of a particular case going forward. Finally, you want to examine the ACDB history. Was there a history of prior disputes having nothing to do with ID theft or fraud issues? For example, did someone dispute an account based on a late notation, only to later claim that the account wasn't his or hers? Again, these facts aren't determinative of whether a fraud occurred, but can certainly help in assessing the risk early on in these cases. So now I'm going to turn it over to Jason, who's going to talk more about the challenges he's faced with these claims as an in-house and a compliance attorney. Jason?
Thanks, Ryan. I'm really, first of all, happy to be here. As Ryan mentioned, we've worked on these issues together for years. He was always a great sounding board when I was a client and continues to be now that our practices sort of dovetail in this area. And so I'm really pleased to be able to talk with you all this morning. We can move on to the next slide. So as we all know, most disputes both direct and indirect, tend to be garbage. We have a really high volume of nonsense that we receive because people read bad advice on the internet and think that these various submissions that they find out there are going to help them. And sometimes they even pay for these. So reviewing these things and staying alert to the disputes that come through that actually have some substance requires folks with a lot of patience and good training. Identity theft disputes are really, I think, challenging to deal with through the eOscar portal, through the indirect channel. And while the FCRA contemplates, because most of them, the eOscar system makes it very easy for consumers to submit disputes that don't have a lot of substance, not a lot of description of the circumstances that led to the fraud. It makes it easy to submit a dispute without uploading the types of documents that might be necessary for a furnisher to conduct a reasonable investigation. And while the FCRA contemplates furnishers identifying the information that would be required to complete an investigation and sending a notice to the consumer requesting that information, Ryan and I have discussed this over the years, and I think we're on the same page that basically we would rather be having the argument about whether our dispute review process was reasonable rather than our initial identification of an issue as frivolous or irrelevant was appropriate. And so furnishers can use the information that's provided, and as I think we heard Ryan say, that what is required of an investigation is sort of on a sliding scale based upon the substance provided by the consumer. And so if you get a dispute that is one of these, account's not mine and you have nothing else, let's check our account records. Let's go through the process of confirming that there's nothing within your own systems of record that would lead you to having a reasonable suspicion that the account was opened fraudulently. And if the answer to that question is no, provide the response that the information is accurate and move on and wait for the consumer to submit more detail about the dispute. I did want to mention briefly that from my background as in indirect lending, I've tried to make my comments here product agnostic, but I think it's important to point out that for indirect lenders, you're relying heavily on cooperation from your original creditors. When you actually get a dispute that has some substance, you might get a driver's license with an image. You don't have that image in your file because you've chosen not to take it for fair lending reasons, for example. But you do want to get the comparison of what the consumer provides in the dispute with what was presented by, to an auto dealer, for example, at the time they purchased a vehicle. And so you're reaching out to your dealers for information and you're relying on their cooperation. And so I think it's important when thinking about your dealer agreements and the obligations to repurchase that a dealer might have if identity theft is confirmed, speaking of those things in terms of risk shifting, that you accept the credit risk, they accept the risk that the person isn't who they say they are, because that's your job. You hear dealers frequently say, hey, what else could I have done differently here? I followed all of my procedures and now you're telling me this account was opened fraudulently. And the answer is fraud happens. Sometimes even the best procedures can't suss it out. And so speaking about these things in terms of risk shifting rather than placing blame, I think from a relational perspective is really important for our indirect lenders. And we can jump to the next slide. So we've heard Ryan say that from a litigation perspective, the focus of plaintiffs' lawyers is really on hyper-technical disputes about the vagaries of Metro 2 reporting, right? The Bureau is focused on process. Are your policies and procedures appropriate given the size and complexity of your activities as a data furnisher? Do you have appropriate testing and monitoring processes to identify errors and respond to them so that your periodic data files to the CRAs don't have a high percentage of errors, and you're working to lower that error rate. And when it comes to your procedures for reviewing disputes, both direct and indirect, can you show that your folks are well trained? Can you show that they're looking at the appropriate information in your account records, and that when two types of disputes come in and they're similar, that they're handled in the same way consistently? So what are some of the things we've mentioned that the FCRA, we heard John Redding say it earlier, FCRA compliance continues to be a focus of the Bureau's supervisory examinations. We don't think that's going to change anytime real soon. Recently, earlier in November, the Bureau issued a report on disputes concerning consumer credit reports. And what they did was basically analyze a sample of accounts being reported to the bureaus that had complaint flags on them, tried to break them into different segments based on product and see what the trends were with respect to those different products. And I think the important takeaways from this report is that the increase in credit reporting complaints to the CFPB is 129% in 2020. It's now the most common complaint topic that they receive. And, I think that's not really surprising given the impact of the pandemic during 2020 and the requirements. I didn't put it in the slide, but the requirements of the CARES Act with respect to how we report when we grant an accommodation based upon a COVID-19 issue. Ryan, I don't know if you've seen it. I haven't yet seen the influx of COVID-19 of CARES Act accommodation litigation yet.
No, I haven't. And it's interesting you say that, because it's something that I know a lot of us in the industry were expecting. And a theory, and this is just a theory that I have, is that, I think that companies, and I know because I was involved in some of these discussions, that when implementing CARES, they were trying to take the most consumer-friendly approach that they could. It was in the middle of a pandemic, so no one was taking an aggressive approach in its interpretation. I think that's helped mitigate the litigation that we expected to see. But that I agree, we have not nearly seen the level of CARES Act litigation that we were expecting.
And I think that's a reasonable assumption, but I think we can also assume that from a supervisory examination perspective, when the Bureau comes in to examine your credit reporting, one of the first questions they're going to ask is, what did you do and how can you show me through temporary amendments to your policies and procedures, or whatever other documentation you've created in response to the crisis. But what did you do and how can you show me you actually did it? I do want to point out that the report mentioned that consumers from a majority Black census tracts were more likely to have accounts with dispute flags. So it raises, when I mentioned earlier that when you're reviewing disputes, making sure that the process is followed, and to the extent there are exceptions, that the reasons for exceptions are clearly documented and that they're limited. Because it does raise a potential fair servicing concern, although the CFPB did note the stronger correlation was between low credit scores and dispute volumes. We can move on to the next slide. So I want to mention in the few minutes we have left here a few activities in enforcement by the Bureau. The first was mainly just because it was interesting to me. Henderson versus the Source for Public Data is a case pending in the U.S. Court of Appeals for the Fourth Circuit. The CFPB, joined by the FTC and North Carolina Department of Justice, filed an amicus brief in that case. The defendant, which was a data aggregator, had successfully argued that at the district court level, that because inaccuracies in consumer reports that they originated, the data was compiled from information available at state agencies and in other public records like court records. Section 230 of the Communications Decency Act shielded it from liability. as a consumer reporting agency under the FCRA. The CFPB's argument is, no, Section 230 applies to trying to hold a publisher liable for speech from third parties in an internet setting. What the FCRA claim made by the plaintiff is trying to do is hold this consumer reporting agency responsible for following the procedural requirements of the FCRA, not holding it liable for the inaccuracy of the report itself. And so the overarching concern here is, I think, as more and more financial services companies start to use alternative methods of credit scoring with the goal of trying to be more accurate and really provide a clearer picture of a person's ability to repay, using alternative sources other than credit reports from the big three credit reporting agencies. There's a concern that the fintech industry could avoid compliance with some of our financial services regulations, arguing we're just a data aggregator, we're just providing a technology platform that others are using, and therefore we're not going to be held liable. The CFPB is clearly concerned about that. We can move to the next slide. I think this case filed in the Central District of California against a cloud repair, credit repair cloud, and Daniel Rosen. This is a company that provides technology to credit repair businesses. And I don't think the CFPB is too concerned about your complaint volumes, but when I noted at the beginning, a lot of the complaints you receive are garbage. This dovetails nicely with your interests and the CFPB's interest in preventing consumer harm, because consumers are paying for these services and they aren't receiving any value because the credit repair organization can't demonstrate the results that they're promising. And so the CFPB is taking an active role in pursuing companies that violate the prohibition that's contained in the telemarketing sales rule on charging advanced fees without being able to demonstrate that you've delivered the results. And next slide, please. To conclude, you've heard me and you've heard John Redding mention the continued importance of to the Bureau in its supervisory examinations of credit reporting and data furnishing. I wanted to give an example of how things can go badly. In the Santander consent order, which was issued in December of 2020, the CFPB alleged systemic errors in data furnishing to the CRAs, unreasonable policies and procedures for the size and complexity of the organization, and which led to, when errors were identified, failing to correct them as promptly as the Bureau would have expected. This included reporting that conflicted with internal account records. And so, again, with the focus on procedure, on reasonable policies and procedures, the Bureau is extremely concerned when your individual account records, maybe there's an account note that talks about, hey, we've identified some fraudulent activity on this account, but you receive an indirect dispute and you just respond that the account record is accurate, right? So this internal inconsistency can be a real problem, and you can see the monetary penalty in addition to continuing compliance plan requirements. The civil money penalty of $4.75 million is substantial. So that is it for me. Ryan, again, thank you.
Yeah, I just had one question, Jason. I mean, I think one of the things that I notice clients struggling with is, how to do these, particularly the fraud investigations, and maybe not even the claims of true identity theft or fraud, but your more generic claims of an 01 dispute. How to work through those while complying with the act, undertaking a reasonable investigation, but still being able to work through the volume. I mean, you've seen this both on the in-house side and now as a compliance attorney. Do you have any thoughts on that? I mean, it's such a difficult kind of dynamic between trying to get through them timely and then at the same time trying to do a good job?
Yeah, I mean, it is a volume challenge for sure, but you know, I could say what we did was create a checklist of sort of basic account records that in every dispute scenario, whether it's an 01 or an 03, you would look at, and then having a separation when it's a true identity theft claim, you move on to these additional items that you're going to address. And you know, again, in the indirect auto space, that would include, you know, potentially reaching out to the dealer, conducting more manual steps in the investigation. But for the very basic disputes that don't include a lot of information, just confirming that not just your demographic information is accurate, but you're going to some basic account records to show that you took a look at the contract. It has a signature on it that looks like it matches the name. Very basic things like that.
Yeah. Have you seen anybody using any type of artificial intelligence or anything along those lines? I've heard about it, but I'm not aware of anybody actually implementing it yet, or more importantly, how that's going to be perceived on the regulatory side. Any thoughts on that? So the answer is no. I haven't seen it in any detail. I would suspect, you know, any time that we're able to automate, to make a process less susceptible to human error through automation, through we see this frequently on you know, on the credit application side, right? Not the fewer applications that have to have manual review, typically the better that is for a creditor. So I suspect it would be something that when the bureau is examining you, that the investment into the technology to make your processes more consistent would be appreciated. Yeah. Well, look, I wasn't kidding when I said Jason and I could kick this topic around for a couple hours, but I do have to stop here. Jason, thanks so much. It was really great, and I appreciate you joining us. So I'll give everybody a minute to join the round table. In the meantime, I'm going to see if I can stop the sunlight from beaming directly into my face at this time of day. So I'm going to go off video for 1 sec and I'll be right back. I think you can see how effective that was. We're gonna deal with that. All right. So Mike, if you could turn on your video and unmute yourself, we're ready for you. There he is. All right. Well, look, I'm thrilled to introduce and be a part of the next panel, which is our litigation roundtable, and our terrific panel of speakers. So first, I'm happy to introduce Mike Galliano, who is the VP of Legal and Head of Litigation for Alliance Data, Comenity Bank. Mike has been with Comenity Bank for more than 17 years, and we have been working together for the past few years now. Mike has some really creative and interesting approaches to the management of high volume litigation that we're going to discuss here today. Next, we have Prabir Chakrabarty, who is the Vice President and Associate General Counsel of Mariner Finance. Prabir has been with Mariner for 13 years, and in addition to managing Mariner's litigation, he is also extremely well versed in FICRA compliance and litigation and many other issues. And last but certainly not least, we have Laura Conroy, who is an Assistant General Counsel at Cenlar FSB. Laura previously worked at Ditech Financial, and before that spent years in an international law firm focusing on mortgage servicing related litigation and defense, and we're thrilled to have her expertise on mortgage servicing litigation this year. Unfortunately, Justin Bradley, who is Corporate Counsel of Compliance and Litigation at Shell Point, was unable to join us today due to an unforeseen work conflict. However, I'll do my best Justin Bradley imitation today and try to relay some of the information he shared during our pre-seminar preparations. Before we jump in, I just want to set the stage a little bit. We've heard from our earlier panels that TCPA litigation is down, and FCRA litigation has increased slightly in 2021. It's also worth noting that FDCPA litigation is also down across the country this year. From our practicing clients, we've also observed a reduction in overall litigation this year, but FCRA claims is what's really remained constant through much of the year. I've also observed an uptick in filings in, I'd say, mid to late September, and those filings are continuing. Jason and I just talked about this, but while we had anticipated a kind of an uptick in CARES Act related litigation, it doesn't seem to have materialized yet. And we can talk about perhaps some of those reasons why. But enough for me, we'll turn it over to our panelists now. And Mike, I'll start with you. What litigation trends has Comenity seen in 2021?
So good morning, everyone, and thanks very much for allowing me to participate. I suspect I will be repeating some things that others have shared already. It sounds like our experience this year mirrors the national trends. And sometimes in the past, we've been ahead of the curve in a bad way. Sometimes we've been behind the curve in a bad way. But it sounds like this time around, we seem to be riding the curve. We have had definitely a significant decrease in TCPA. We had that even before the Facebook case. I presume our experience was as the auto dialer definition matter slowly worked its way through part of the country in our favor, it helped us with our settlement posture in a lot of cases. And then, certain reasons just essentially got blanked out. And then Facebook came, and that was great. What we tried to do was to stay as many cases as possible pre-Facebook. The thought was, if it goes for us, that'll really be good. And if it goes against us, it goes against us, but probably the upside was better than the downside, and that worked out well. We ended up selling a lot of cases quickly after Facebook, and we're very pleased with the results. One thing we're experiencing that I don't know if it's similar to others, volume is down, but not dramatically. It's only down about 10% for the year, but cost is down dramatically. I'd like to take credit for all of that, but that would be inaccurate. Certainly, good outside counsel such as yourself and others have a lot to do with that. I suspect some of that has to do with, your average TCPA case was just worth less this year than the past. But the growth was an FCRA, which I know is common with your other clients. And we haven't had a chance. At the end of the year, we'll go back and really get in some very granular testing on things. But I had been warning our senior management for years, FCRA is going to cost more than TCPA, apples to apples, because you get involved in multi-party litigation. It just drags everything out. It's more complex. It's harder to keep people out of litigation, or at least out of the courts, and just do things in a settlement posture. And it's more fact intensive. TCPA is pick a number, multiply by 500, start negotiating down and see where you end up. FCRA, very fact specific. So, however, since our costs are down and FCRA cases are up, that really cuts against my hypothesis. I hope I continue to be wrong. I'm wrong often on many things. It usually doesn't work to my benefit. But so that's where we are. My speculation is that the plaintiff's bar is sort of retooling. They're just trying to figure out new things. We've experienced that with a couple of novel claims recently, and by different players than we're accustomed to seeing. So, 5 years ago, it was a Lemberg kind of world and some other names you would recognize. And we're seeing a bunch of new people with whom we don't have established relationships. So it'll be interesting to see where that goes. But I think I just told you, same here as everywhere else, but I took a lot more words to say it.
Thanks, Mike. Prabir, how about you guys?
Yeah, a lot of what Mike said is correct, and I also want to thank you, Ryan, for including me in this. Yeah, unfortunately for my friend, Zach Miller, who spoke earlier today, we have not only not seen any TCPA, knock on wood, claims, but I've noticed that some of the serial filers that we used to get have struck it from their pleadings. So we definitely have seen a decrease in that, and a consequent, just like Mike said, increase in FCRA claims. I know you talked about how they're kind of hyper technical, what you're seeing. I just see the sophistication of the plaintiffs bar in terms of FCRA claims has gone up considerably. Just from the pleadings, from some of the earlier claims that we gotten, I don't think that a lot of the attorneys who are kind of dabbling in it had really any idea about, what they're really filing. They were just looking for a quick, which some of these hyper-technical ones are doing as well. But I just see a much greater sophistication and what the types of claims and I think it's correct to say that they're hyper-technical, but to Mike's point, I think as that some of this is a transition, and as a lot of these TCPA players or other players in this space get to know all of the various pitfalls of FCRA litigation, that we're going to see an even greater increase and to Mike's point, a higher demand and or willingness to take to trial.
That's great. Thanks, Prabir. Laura, what about at Cenlar? What did you see this year?
Well, one thing that we've seen really since the start of the pandemic is typically we see a large number of contested foreclosure cases where we're dealing with counterclaims or we're dealing with TROs in the non-judicial states. And obviously with the moratoriums in place, there has not been those cases going forward. But our overall number of litigated matters has not dropped off. We've still seen a steady flow of FCRA cases, a lot of RESPA, just kind of a smattering of different types of claims. Those have continued coming in, and obviously as the moratoriums lift, we're anticipating to see a lot of counterclaims and contested claims coming in as borrowers start to face foreclosure.
Yeah, and I think that's consistent with what everybody's saying. On the FICR side, I just want to make a comment. I mean, as far as reducing costs, we're actually experiencing something a little different this year. I think Prabir is right on the sophistication of the FICR bar for plaintiffs' attorneys, but also what we're struggling with, and I've talked to other attorneys in the space across the industry, is we can't even get demands, which is slowing down the time to conclusion for these cases. So I can't even get a plaintiff's counsel on the phone for a case that I think is hyper-technical of limited value to just give me a demand. So I don't know whether they are not good from working at home, whether or not they're filing so many cases, they're having a hard time keeping their head above water. But certainly that's something that I've seen and we're struggling with on the defense bar and the defense side, is just moving these cases along with the degree of speed that I know that everyone on the phone wants their outside counsel to see.
Hey, Ryan, I'm just speculating. Yeah. I wonder if maybe that's a sign that in a TCPA case, you get your plaintiff, they tell you how many calls they think they got, and then you go and you call Ryan to settle the case for his client. And you don't have to go back to your client much. You don't have to dig up many facts. You don't really have to worry about proving damages. You just start playing the math game. Consent, non-consent, how many calls, and which apparatus was used. My speculation is that maybe it's because these attorneys, there's more work for them to do in each case. And so their time gets spread, and since they're already trying to work high volume and they're inattentive by nature, if they're not offended that I say that, and even if they are, it just breeds that. And that maybe what they need is they need more, I think about my wife and her law firm, maybe what they need is more staff who can be the ones calling the clients and saying, okay, now we need to follow up. You need to send us the letter. You need to, answer these questions. And that I'm just speculating that maybe those plaintiffs' attorneys are unprepared to make those demands, because these cases are not as cookie cutter as what they've been working before, and they're just not staying on top of it. And consider the plaintiff base. You know, I think they're all lying. So we start from there. They're disorganized. They don't have the information. They've got to make it up. Again, I'm just speculating. I can't prove any of this.
No. It's a fair speculation. There's no doubt in my mind that it's more difficult for the plaintiff's bar to work at an FCRA case than it is a TCPA case. It just is, right? Even if you have a hyper-technical violation, they're still trying to figure out what the damages are and the impact on credit is. So it's more work for them. I agree with that. And maybe you're right that the prior model that they had didn't have them working as much. So it's an interesting thought. Prabir, anything to add on that?
Yeah, I was gonna say never underestimate the laziness of plaintiff's counsel. But I will say to Laura's point though, when she brought it up about moratoriums, I have seen from some of the players, at least in the FCRA space, that they do bankruptcy work on the side, and I see a lot of confluence between those two practices. So I know with the moratoria that is going on right now, and actually with the trends and valuation of homes, we have not seen the huge increase in Chapter 13s that I think everyone in the industry has been expecting, and or 7s. And so, you know, some of it may be a wait and see also on these, at least the ones who actually the attorneys were expecting to see that increase, that, you know, they're still playing a wait and see game in terms of what they're going to be doing and focusing on for this next year.
Yeah, I mean, on the foreclosure side, I did want to share something that Justin Bradley had relayed to me, which is, you know, there are limited exceptions to the moratorium right now. And so in September, they kind of restarted some foreclosures related to those limited exceptions on the moratoriums. And what they saw was a 30% bump in litigation for the first few weeks that they did that. So it's just kind of an interesting data point for the group to take away. The other thing that Justin mentioned that nobody has kind of touched on is the 11th Circuit's Hunstein decision. And so just for those on the call, as a reminder, in Hunstein found that the plaintiff sufficiently pled a claim for unauthorized third-party disclosure under the FDCPA when it sent certain information to its mail vendors, who it found were third parties who received the communications concerning the consumer's debt. And given the extensive use of third-party vendors in the industry, mail vendors, consumer finance companies were rightly concerned this was going to be the next cottage industry. However, this didn't materialize. I can tell you that Justin relayed that they had seen some copycat litigation, and there's certainly gone on through the year of Hunstein-related litigation. It just hasn't been successful. Courts have not picked up on or been willing to adopt the 11th Circuit's view on this. And recently, the 11th Circuit vacated its own prior decision, and now a full panel of 11th Circuit judges is going to hear this. So my hope and my expectation is that the 11th Circuit corrects what I believe is a clear error in its expansive interpretation. But Prabir, did you guys look at that issue this year, and do you have anything to comment on that?
On Hunstein, yeah, no, we were following it very closely. The way that the initial decision came down, the impact of essentially the vendor relationship, sort of compounding upon itself. We were very concerned. We've been following it. Sounds like the en banc and essentially the redecision by the court. I mean, I have to say that the original decision by the judge, and essentially saying that, we know this is going to turn the whole industry upside down, but, that's for the legislature to deal with, was pretty interesting. And I'm hoping that, we'll get a lot more clarity. But, I think, as with these other things, I think some of it is the industry. We have not seen any of that as of yet, but the industry or the plaintiff's attorney is trying to figure out how valid these claims are going to be.
And Laura, how about you? Is that something that you were concerned about this year, or that you've seen?
I would echo what Prabir said, that when it came down we were very concerned, but it hasn't materialized in a lot of litigation, at least so far. Touch wood, you know, time will tell, but so far it hasn't turned out, you know, as we were concerned when it first, the opinion first came down, thankfully.
So let's kind of look into the crystal ball. I think what would be useful is let's think about 2022. Laura, what are you expecting? What are you planning for from the litigation side for 2022?
We're really expecting an uptick in foreclosure related litigation. You know, once the moratoriums are lifted, and even local, you know, one thing we've also seen is even some local jurisdictions, while there might be a limited number of loans eligible for foreclosure, you know, some sheriffs aren't scheduling sales and, you know, aren't, you know, wanting to proceed with things. But as foreclosures resume, you know, we're expecting to see more TROs, more contested claims. But we're also, you know, interested to see if some of the mediation type programs, like the conferencing program in New York, for some borrowers who maybe don't really understand that a forbearance means they still owe that money if they don't make other arrangements to modify their loan. It'll be, you know, time will tell state by state how many states embrace that type of a program to get borrowers back performing on their loans for those who are eligible. But that's really for us is the big question mark, is the foreclosures, and at what point, you know, whether it's first quarter, they really pick up, second quarter, that's going to be the big, you know, what we're expecting to see a lot of cases coming in.
Is there anything that you can kind of look to that's occurred historically, or that you're looking to that's occurred historically? Like, I know we talked about some natural disasters that kind of give you some guidance or guide rails to this.
What we had talked about before, and I think might be a useful tool, is in Texas after Hurricane Harvey, there was the forbearance program, and there were some borrowers who quickly resumed their payments and caught up on that, but there were others who really did not seem to understand that they needed to modify their loan if they weren't prepared to make up those payments. And there was some litigation that came out of that part of the country following Hurricane Harvey. So I think, you know, based on that, I think there's going to be a population of borrowers who, you know, think that was a free pass for those months. But going along with the modification programs, we have been seeing a lot of borrowers, especially with the GSEs, FHA loans, getting partial claim loan modifications, where their arrears are, you know, HUD is allowing them to kind of put a balloon on the back of the loan. So to the extent we keep getting those directives from the GSEs and they continue approving those types of loan mods, I think that might, you know, stave off some protracted litigation to the extent borrowers take advantage of those types of modification programs. But again, that depends too on the government extending some of those programs, as they did with HAMP. We saw them extend it time and time again. You know, I believe Biden was pretty heavily involved with that. So I think it's likely to, or reasonable to assume that they'll give some of those extensions again, but it's hard to say for sure.
Okay. Mike, what are you guys expecting for 2022?
Well, since we're, you know, pretty much credit cards and similar retail type lending, we don't have as many challenges, I think, as people that have a broader set of products. So that's a positive. Again, I'm speculating, but my speculation is the plaintiffs' attorneys are going to be looking to leverage the CFPB. So when the CFPB comes out with some statement about, we're very concerned about X, we're going to start seeing more lawsuits about X. If I had to guess, I would say ECOA type matters. And, you know, when the CFPB now is going to shift back into its, you know, regulating through penalties and fines, but that's another sort of, you know, okay, that's a good area, because we'll use the CFPB letter, proclamation, consent order, whatever, to sort of tell the court, you see, it's a problem. So that's one bit of speculation. I suspect TCPA will keep winding down. I suspect FCRA will keep going up. And then I don't know. I think that there seems to be a shift towards the I think there's more people who want to start doing big cases. I think for the last few years, it's just been a lot, it's a lot of people making a lot of money off of high volume, small dollar cases. And we're seeing a little bit of the bigger, people trying to make bigger hits. Class action can't always be done because of arbitration clauses, but that sort of, fundamental, your website is wrong on everything type case. That is definitely a concern because those are a lot harder to deal with.
Yeah. Prabir, how about you guys?
Yeah, well, Mike just mentioned the CFPB and the revisions to Reg F that went into effect on November 30th. I think we're a first-party creditor, and there's been a lot of back and forth as to, why they excluded first-party from that rule by the CFPB. But I think it is clear that they specifically talked about the UDAP, that the compliance of UDAP principles for all of the things that are coming out. And so I think we're going to see a lot of litigation early on because, there are states, obviously, that specifically talk about or specifically use the FDCPA, and now that it's been revised, I think we'll see a lot of plaintiffs' attorneys trying to figure out how far they can get with that. So I see that, and then the other trends, as Mike said, I agree, more FCRA, less TCPA, but I think it's very fluid, and I'm hoping things stay sort of at this space, but we obviously always want to make sure that we're looking ahead if something else does bubble up.
Yeah, I mean, something's going to have to fill the gap of those TCPA cases. That's what I think about, right? So, that was made up a lot of claims brought by the plaintiffs' bar who are in the consumer financial services space. So those claims are going to go somewhere. I don't think they're going to pack up and do something else. I think they're going to look for the next thing. I don't think the next thing has come up, but I think your comment on Reg F is a good one. It's just another area to potentially look at. Moving off of the claims, Mike, can you just talk a little bit about your utilization of some of these litigation management tools such as CounselLink and how you guys use it to manage litigation and what functionality you think is most helpful?
Well, there are other people on their team who could speak to that with much more knowledge than I, as you know. But I do think this, and I'll take off of my last comment. I think that in preparation for bigger litigation, the better record keeping, the better digital resources you have, the better. What I have found the situation I found us in several times, and we're in it right now on a large matter, is, and let's go back again to the never underestimate how lazy the plaintiff's attorneys can be, is here come the plaintiff's attorneys. We've got this huge case. We've got a lot of plaintiffs, or we have this common issue, a problem with your website, whatever, and here's everything. Well, while it's their burden to provide proof for us to respond to, they don't do that because they haven't collected it all, but rather they put this enormous burden on. Essentially, we have a choice of either saying, well, you haven't given enough proof that you have a great case, so we're not going to talk to you, in which case they'll just sue us and then do the discovery request. Or we can spend the time figuring out ways to do searches in our own systems for how many account holders in this, with this fact pattern in their account history. And, some members of our team are frustrated because why are we doing their job? It's almost like we're giving legitimacy to these meaningless claims, which I appreciate and respect that should be your first thought. It's all wrong, but we're in this mess. So I would rather vet their cases before they do and do it at my own pace. So you're not imposing on the business with court deadlines. And I'd rather do it without a case having been filed that the world knows about. So I have found myself relying more and more on the team members here who know how to work with the business folks to be doing these specialized searches into common fact patterns that go to things like account closures, credit line decreases. That's a big one. You know, I think in the business, in our business, I'd say the industry as a whole, there's a lot of focus on how can we be more efficient? You know, when should you start closing down accounts when no one's made a purchase in X days? And sort of trying to find your best customers and narrow that down. And every time you do that, there's a consequence because somebody's credit lines being decreased or their accounts being closed or whatever. And how do you track all that? So I think, not surprisingly, that the technology just becomes more and more important. Artificial intelligence, very important. We've, you know, really in the last 2.5 years particularly have exponentially grown what we're doing in that. And that has helped us with account retrieval, data analysis, risk assessment. So I guess the short answer to your question is yes, now more than ever. And the longer answer is there's just more and more situations that lend themselves. And if we can quickly, inexpensively, and without a lot of associate time and burden, figure out things, it helps us posture when, you know, the bad guys come, and to set the narrative of, well, you've said 15 things without any evidence. I can tell you just based on statistics that there's only 1% that fall into that category, 3% fall in that category, and we're not going to settle with you for huge dollars on that. So if you can go find more information, good to you, but that's not, since they're just here to get a check and move on, that's how we're trying to affect the rules of engagement.
Yeah, I think the emerging technologies are going to be extremely useful, particularly in the class actions and the class space, just for quickly identifying data sets and ascertainability in class actions. Laura, anything on kind of the legal tracker, Counsel Link, the way you utilize those to kind of manage your litigation teams?
Sure. We use Counsel Link at Sunlar. And for us, it's been an incredible help in doing reporting for the board and kind of trying to do reports to see what types of claims are coming in and see how matters are, you know, being resolved and looking at spend. Personally, I really find the budgeting tool very helpful for looking at invoicing and kind of checking in with firms to say, hey, how's this going? Where are we headed with this? You know, to kind of look at our spend versus the exposure on a lot of the cases. And it's also been helpful to, you know, having outside counsel put in updates. It helps us a lot with reporting as well. So, you know, we found it to be a very helpful tool.
Yeah, and I just want to echo, I mean, Justin's comments on this point kind of go along with Mike's in that they use Legal Tracker. And for him, he was saying how important a tool that was this year because they onboarded a significant volume increase through some portfolio acquisitions. And having that system in place was very, very helpful for them in terms to quickly assign out the litigation to their approved counsel. The other tools that they utilize it for, and Mike, I know you guys do too, which is they track outside counsel. I mean, outside counsel like myself are constantly scored through using those litigation management tools because the teams can quickly assess how long a case has been open, what was the disposition, how much did we pay. They can submit monthly updates through it as well. So it's really become a very useful tool in the management of high volume litigation. Laura, we don't have much time, but I did want to just touch on alternative fees. Have you used them? Do you find success with them, those types of fee structures with your outside counsel?
So Sunlar does not do, or at least we have not yet gone to alternative fee arrangements. You know, I would say it's something we would never do down the road, but it's just not something we use. However, when I was at DiTech, we had a very large alternative fee arrangement program nationwide, and it was very helpful. It really allowed us to develop some efficiencies with some of the firms because we were, you know, had preferred counsel in, it was state by state. And we used some law firms in multiple states. The only pitfall to it that I ran into periodically was with some firms who had put out a bid based on a larger geographical footprint than they were awarded. So it became maybe less profitable for the firms, you know, on that fixed fee amount that they had bid. And so they were, you know, staffing some matters with staff attorneys, or, you know, it might not have had a financial services litigation partner resident in the office who was really monitoring the portfolio in that case. So some of those matters we just had to monitor more closely and kind of make sure they were checking in with the people in that local office. But by and large, you know, I had a good experience with it. You know, it cuts back on invoicing for accounting, you know, some of those kinds of things that trickle down to other parts of the business. You know, the AFAs, you know, help with some of that too. I mean, so, you know, I found it to be a helpful tool, you know, as long as it's something that supports the business of the company and the firm's interest as well, because, you know, our lawyers want to get paid too. So it has to be in everybody's interests.
Yeah, I think you hit on a really important piece, which is, you know, we're definitely open to these, but it has to really work for both sides. Like we come at these from a partnership level, right? It has to really be a partnership between us and our clients in order to make these work effectively. Because to your point, if the firm is losing a ton of money, what may end up happening is they're putting lower level associates or staff attorneys or contract attorneys on your matters. And that doesn't always have the most effective or efficient result. So you got to find that sweet spot. And what we try to do is, you know, continue to keep hourly rates, you know, for the cases that we're working, and then sharing efficiencies, kind of giving over our metrics to show, you know, did we have a windfall, or are we getting killed with a particular fee structure? And what you always hope is that your clients kind of look at that and say, okay, let's try to find an area where we have common ground. Because for certain repeat litigation, if budgets are a concern, or if you're limited on staff, it can work really well. It's just a matter of finding the cases that work, and then, you know, working with your outside counsel to find that sweet spot. Prabir, anything to comment on that?
Yeah, I will say that we have not been using alternative fee generally, but we had one matter, and I guess good or bad, we do not have a lot of cookie cutter similar types of claims. I mean, generally, but they all have very fact specific patterns, which we were discussing earlier. So, but we had a number of arbitrations with the same counsel, and we were able to, yeah, I mean, it was great to have that efficiency and for budgeting, know exactly how much we're going to spend. And just going back to the one other point, we have been using, and you may mention in the prior discussion, for the CROs filing the exact same disputes, we actually have worked with an outside company to use some AI to basically allow us to go through those and really winnow out the ones that we need to elevate. And that is the trickiest part in it, because you don't want it to, I know there was a consent order earlier this year where a company was accused of basically just doing that and not actually reviewing it. So that is the tough part, is to make sure that you are, your AI is good enough that you are always going to be looking at the ones that need to be elevated and looked at more closely.
That's great. All right, well, we've gone a little bit over our time, but this is, I think, incredibly helpful. I love hearing all these different perspectives, and I really appreciate you taking the time out of your respective days to kind of give some insight to the group. So thank you all so much for participating today.
Thank you, Ryan.
Thank you.
Thanks.
Last but certainly not least, we have our final presentation of the day, which is our ethics presentation by Marisa DeFeo. Marisa is a partner at Saul Ewing and a key member of our consumer financial services litigation team. She's been with us since she was a summer associate and is, simply put, a fantastic lawyer. So Marisa, take it away.
Thank you so much, Ryan, for that warm introduction. I'm thrilled to be here today and to chat with you about the ever exciting ethical issues that frequently arise in class actions. I'm going to focus on two different categories, and we can go to the next slide. First is communications with class members and how to do so in an appropriate and ethical manner. And the second is considerations for settlement communications and negotiations with class members. I'll try to keep everyone as awake as I can, because I know the rules of professional conduct aren't necessarily something that most of us would be leisurely reading at night. And I will say, be prepared and get ready, because we're going to have some polling questions as well to keep everyone engaged. And I'm sure Ryan might have an awesome prize lined up for the top score. So let's dig in on communications with class members. Let's talk first about settlement communications. Who does plaintiff's counsel actually represent for purposes of the no contact rule? Let's talk first about the general rule. So under Model Rule 4.2, when representing a client, lawyers shall not communicate about the subject of the representation with a person they know to be represented by another lawyer. We all know that, right? However, unless you have the consent of the other lawyer or authorized by law or court order. That's the basic premise. If you look down at the comments at Rule 4.2, Comment 3 notes that under Rule 4.2, it applies even if the represented person initiates or consents to the communication. In such cases, the lawyers must immediately terminate the communication. We also look at Model Rule 4.3. This establishes a lawyer's obligations of communicating or even dealing with an unrepresented person. In dealing with an unrepresented person on behalf of a client, lawyers must not state or imply that they are disinterested. You also have to take reasonable efforts to correct any misunderstanding about the lawyer's role in the matter. Lastly, you can't give legal advice to persons if you know or should know that the interests of such persons are or have a reasonable possibility of being in conflict with the client's interest. So now that we've laid the foundation, let's talk about how this impacts class members. So the critical distinction here is certification, right? So what's the rule if your class has been certified or if it's post-certification? Let's talk first about the majority rule. So post-certification, New York and most jurisdictions bar contact with class members after the certification process. How about prior to certification? There, the majority rule is that after a class action is filed, but prior to certification, contact is permitted between counsel for a defendant and members of the putative class, but not between defense counsel and members known to be directly represented. In jurisdictions that follow the majority rule, prior to the class action being filed, a prospective defendant is free to communicate with potential class members in order to remedy alleged grievances and obtain releases from liability. And courts have recognized that defendants have an interest in communicating with these class members prior to certification. If you look at kind of our footprint, New York and New Jersey both permit contact prior to certification. What's the rationale? Why do we allow this? If you look at ABA formal opinion 07445, if anyone's taking notes, it provides that the putative class members are not represented parties prior to that certification of the class and the expiration of the opt-out period. Therefore, ABA Model Rule 4.2 does not prohibit counsel from contacting those members. Now, let's talk about the converse of that, the minority rule. As you might guess, it's the opposite. The minority rule interprets the Rule of Professional Conduct 4.2 as prohibiting counsel from contacting class members, even before certification. Pennsylvania is in the minority, and a violation of this rule could result in sanctions. Another more interesting nuance that comes up in this area is the choice of law. So what happens if you have class members in different states? There's a 2019 EDPA decision that's instructive. This is Wellers versus Dollar General. This case involved a class action that was brought by its employees against its employer, pending in PA federal court, where plaintiffs were seeking but had not yet moved for nationwide class certification. Dollar General was also a defendant in a class action brought by employees pending in New Jersey federal court, also pre-certification. So whether counsel in New Jersey can communicate with members of the putative New Jersey class prior to cert is a question for New Jersey law, even though the putative New Jersey class members could also be members of that putative PA nationwide class. So how about counsel in PA contacting members of the New Jersey class prior to certification? Is that proper? They may be able to contact members of the New Jersey class prior to certification, even they are also members of the PA nationwide class potentially, because New Jersey permits such contact. But the opinion does urge and recommends raising the issue with the PA court prior to any contact by that New Jersey class member. How about communications for gathering information? Are all current and former employees of the adverse party off limits, or can you talk to them? Comment 7 to ABA Model Rule 4.2 states that where an organization is the represented party, Rule 4.2 prohibits communications with those persons who supervise, direct, or consult the organization's lawyer concerning the matter, or those who can bind the organization with respect to the matter through their action or inactions. The rule does not prohibit communication directly with the organization's former employees, though. So that is a way in which you can try to still communicate and gather information without violating the professional rules. Let's go on to the next slide. We're going to have our first poll. So which rules apply to these contacts? If the lawsuit is in New Jersey, you are a Delaware lawyer and the class member is in Pennsylvania. Is it all 3 states? Is it New York, New Jersey, or Pennsylvania? And I'll give you a couple minutes if you want to go ahead and select the voting buttons that have appeared up on your screen. All right, so we can go to the next slide. So the answer is actually C. We had most people indicate that it should be all 3 states. A couple folks said New York and 21% said New Jersey. So the 21% with New Jersey is right. And that comes from Rule 8.5B1. The rules of the forum govern the actions of the attorney appearing in that particular litigation. Let's go on to the next one. So before the class has been certified, can you contact class members who are not specifically named in the complaints as being represented by counsel? We have yes, no, or maybe. And I'll give everyone one more minute to put your responses in. So the answer to this one is maybe, C. So we had a pretty even spread amongst the responses for this one. C is going to be the majority rule. Again, this is going to be New York, New Jersey, California follow this. That until a class is certified, the lawyer who filed the lawsuit represents only the named plaintiff or plaintiffs. But remember, if you're in Pennsylvania or some other jurisdictions that follow the minority rule, you're not even allowed to contact them even before certification. So be really mindful of the jurisdiction that you are in and what rule is applied there. And then be also cognizant of that choice of law provision as well, whether or not you have class members that might be in a different state. Let's do our next question. So after the class has been certified, can you contact class members who have not specifically agreed to retain counsel? And the answer to this one is no. So once the class has been certified, for purposes of the no contact rule, which is Model Rule 4.2, plaintiff's counsel represents the entire class. Well, hopefully that was fun and you enjoyed some of the quick questions. Let's switch gears to the second topic. This one has to do with class action settlements, and we're going to talk about 2 key issues that frequently come up. The first is differences within the class on settlement decisions. If some members just disagree with the proposed resolution. And the second is restrictions on counsel's ability to file future claims and what that looks like and what is appropriate and what is not. So generally speaking, a lawyer may advocate a settlement that he or she believes is in the best interest of the class, even if the named plaintiffs and class members disagree. In other words, the practicality of class actions precludes any requirement that the lawyer withdraw wherever class members disagree. And this makes sense because if you're dealing with a large number of class members, there's most likely going to be a few that disagree. And just because that happens does not mean that you have to withdraw your representation. It just needs to be in the best interest of the class. Additionally, a lawyer's decision may not be influenced to increase his fees, or any decision that should be, or any fee decision must be fully disclosed to the court. Okay, well, what happens if class members disagree with settlement decisions? Class counsel may withdraw from representing the objecting class members, and they can still continue to represent the other class members. The Lazy Oil Company, Whitco Corp. Third Circuit decision from 1999 allowed just that to happen. It's a really great case to kind of dig in and understand those particular issues. Also, let's talk quickly about how you're communicating those offers to class members. Comment 2 to ABA Model Rule 1.4 provides that a lawyer who receives a settlement offer from opposing counsel must inform the client of its substance, unless the client has previously authorized the lawyer to accept or reject the offer. We all know that basic rule, but what happens when you have a large class? The settlement agreement itself will outline the proposed method and procedure by which parties will notify the class members. And the final binding decision on what notice to issue is the discretion of the board. Let's do a couple more fun questions. So if some of the class members are opposed to a settlement proposal, can class counsel still support it? A is yes, even if it is the class representative. B, yes, so long as the class representative is not opposed. And C, no. So which one of those do you think is the best answer? So this one is A. Yes, even if it is the class representative who's the one who's objecting. The lawyer's duty, again, is to the class as a whole. The lawyer always has the option to resign from representing the dissenters when moving the court for approval of the settlement. And I also want to note quickly the aggregate settlement rule. So let's talk a little bit more about that. Under Model Rule 1.8G, it provides that a lawyer who represents 2 or more clients shall not participate in making an aggregate settlement of the claims of or against the clients without court approval, unless each client gives informed consent in a writing signed by the client. Of course, informed consent from an entire class is not possible, and a few states' versions of Rule 1.8G specifically exclude class actions from the application of the rule. So make sure you're aware of what happens in your particular jurisdiction. For example, California has the rule that specifically says that the rule does not apply to class action settlements subject to court approval. Likewise, Louisiana, Virginia, Maryland, and DC have no court approval exceptions. But note that the rule only applies to the counsel who is representing multiple parties, not the opposing lawyer. Let's go to the next question. So can class counsel agree to not file similar claims in the future? A is no, but an agreement not to file may still be enforceable in some jurisdictions. No, and the agreement is not enforceable. Or C, yes. I'm going to give you a minute more to respond for this one. So the answer here is A, no, and that's most jurisdictions. So that's under Rule 5.6A2. It bars such a restriction in the settlement agreement. And let's talk a little bit more about that and where that comes from. So generally speaking, plaintiff's counsel cannot agree in connection with the settlement of disputes to refrain from bringing on behalf of other future plaintiffs actions similar to the one that's being settled. And this is derived from Rule 5.6A2 that provides, quote, a lawyer shall not participate in offering or making an agreement in which a restriction on a lawyer's right to practice is part of the settlement of a client controversy. But be mindful that there are a few decisions, particularly in New York, there's quite a few that have gone the other way. For example, in Blue Cross and Blue Shield of New Jersey versus Philip Morris, it's a case pending in the Eastern District of New York. The court held there that the agreement where one law firm promised not to represent a client against defendants in exchange for defendants refraining from disputing, similar representations in other forums. They said that was valid and it would be held unenforceable under the rule. So really interesting result, and be mindful of some of the exceptions that might be out there to that general rule. Let's go on to the next slide. So this is kind of more explanation of other ways in which you cannot restrict the right to practice. Again, it includes all of that stuff, even with regards to a settlement offer. You can't put any strings attached, in the settlement offer that you're conveying to plaintiff's counsel. Other prohibitions, we talked about the right to sue and bring other claims. You cannot restrict the plaintiff's right to advertise, and you're not able to restrict the plaintiff's use of certain information contained in the litigation itself. All of those would result in, the actual agreement being void as a matter of law, and you could be potentially sanctioned as well. That concludes our presentation, or my portion of the presentation today. I hope I kept you all engaged and it was interesting as much as ethics can be. And if you have any additional questions, I'm happy to answer those as well.
Marisa, thanks so much. That was terrific. Before everybody leaves, I just want to give the last code, last CLE code. It's 34975. 34975. That's the code that just needs to be recorded and given back to us when you receive the survey. So that concludes today's webinar. I hope everyone enjoyed it. Please remember to keep an eye out for our follow-up email, which will include links to the program materials, the recording, and the CLE survey. And finally, if we didn't get to your question, we will send you a response via email. And in the meantime, feel free to reach out to any of our presenters with any questions you may have. Thank you so much, and have a happy holiday.